9 and no, we don't know. They should be coming here. Hopefully. In case. It's a different thing. Right. So we don't call them out. So Burako he didn't like me. I told him I'll call you up. He said you email me. So but they don't get to they don't take for people. Take a quick break. Huh?
So you will also be the co-host and Rajeshwari and Jayati.
No, who is the co-host? Please, am I?
No. I mean today I think it was Jayati. Because I think Jayati.
Sort of coach is the.
He's a chair.
Chair.
But backup chair. No,
OC. I'll come back.
hello everybody. Welcome back to the 19th Macroeconomics and Finance Conference, the final day of the conference. Today we have the first set of paper presentations in the panel of central banking, which will be chaired by Dr. Saurabh Ghosh from Reserve Bank of India. After that, we have a keynote speech by Dr. Arvind Subramanian. And then we end, of course, with a very special session in honor of Dr. Subir Gokarn, which will be presided over by our IGIDR Director and Vice Chancellor, Professor Mahendra Dev, with Dr. Subbarao as the chief guest. So without further ado, I would like to invite Dr. Saurabh Ghosh to chair the session. Saurabh, the floor is yours. Thank you so much.
Yeah, thanks for sharing. Am I audible?
Absolutely, yes.
Okay, great. Thank you very much. Indeed, a pleasure to chair the session on the very final day and on a very interesting topic. We have three very interesting papers, which ranges from oil price distribution and oil price shock to communication, Taylor rule, and the impact of communication on inflation. Commodity prices and inflation also is covered in another paper. So, and the slots are very time bound. So we will have 20 minutes for each presenter, followed by question and answer session. So the papers are indeed interesting, and I can't hold myself from listening to the speakers. So without further ado, I will request Ishika to present the first paper, which is on the oil price shock. Over to Ishika.
Thank you, sir.
Thank you.
Is my screen visible?
Yeah, it is. Yes.
Okay. Good evening, everyone. I am Ishika Kataruka. I have done my postgraduate in economics from Madras School of Economics this year. And the title of my paper is Monetary Response to Oil Price Shock in Asian Oil Importing Country, Evaluation of Inflation Targeting Framework. This paper is jointly written with my professor, Devismita Jina. So as we all know that crude oil plays a very important role in a world economy, and that the demand for crude have significantly risen over the last 2 decades, that is 24% worldwide. Talking particularly about Asian countries have seen their oil consumption rising by 36% during 2008 to 2019, and during the same period their domestic production have reduced significantly. Quoting the latest 2019 number, we see that Asian countries have consumed 4.5 times more oil than what they have produced. This clearly shows that Asian countries are highly dependent on imported oil to meet their economic requirement. And moreover, most of this oil comes from volatile Middle East, making this country more vulnerable to oil price shock. Since oil is both the consumption and major input in the production process, oil price movement have a great implication on the growth and inflation of any economy. Thus, it is very important to examine how does the central bank react to oil price fluctuation to maintain its objective of macroeconomic stability. Moreover, we have seen that these Asian countries have also shifted to inflation targeting framework because of Asian crisis of 1999 and later because of global crisis of 2008. So basically, these countries have completely abandoned their earlier framework of either targeting exchange rate or be it monetary aggregate or be it multiple indicator, and now have adopted inflation as a core variable to guide their monetary policy. So the guiding principle behind the shift in the framework is that central bank should primarily focus on price stability in order to maintain its long-run objective of macroeconomic stability. But question is, how effective is monetary policy? In particular, how effective is monetary policy in inflation targeting framework in the face of oil price shock for macroeconomic management? So there's two main objectives of this paper. First, to examine how does the central bank react to oil price movement for 5 Asian oil importing emerging economies of India, Vietnam, Indonesia, Thailand, and Bangladesh during 2008 to 2019. The motivation behind this objective is that these countries are highly dependent on imported oil, and oil price movement have implication on inflation and the growth. Also, these countries have shifted their monetary framework over the time. As we can see in below table, India shifted to IT framework in 2014 to foster price stability. Similarly, Indonesia and Thailand shifted to IT framework because of the Asian crisis of 1999, and Vietnam and Bangladesh still follow non-IT framework. So this formed the second main objective of this paper. First, to see does the monetary framework followed by the country do have any impact on central bank decision to oil price shock? Does monetary framework play any role? And second is, does the central bank react to oil price shock differently while operating in IT framework as compared to non-IT framework? So oil has a rich literature. HISRI 2019 paper have given the direct and indirect effect of oil price fluctuation. Direct effect in terms of increase in the production cost, since oil is major input in the production process. Indirect cost in terms of increase in the revenue of oil exporting country, allowing oil importing country to export more of its final good. And finally, he concluded that in oil importing country, direct effect in terms of negative supply shock is dominant. And then Gorgia mentioned that there is a need of monetary accommodation. Hamilton very well said that supply shock can actually induce demand shock in an economy. So basically what happens is when the oil price rises, this lead to increase in the production cost, that is a negative supply shock in an economy, and producers then tend to pass this increase in production cost to consumer in the form of higher prices, which lead to inflationary pressure in the economy and the real income and aggregate demand fall. When this happens, there is an uncertainty in the economy and saving rises and investment further fall, leading to further fall in aggregate demand. So we see that something started with supply shock can actually become a demand shock, and any economy would like to avoid this loop. So there's a paper by Romer which states that central bank react to oil price shock to maintain price stability. Basically, in the short run, central bank increases the rate of interest to abate the negative supply shock impact. Whereas in the long run, when the supply shock is more of permanent in the nature, the central bank actually lower the interest rate in order to provide the necessary demand stimulus to the economy. There's another viewpoint regarding how should central bank react. Which is with the background of US economy facing a slowdown in 1970 to 1990. So Bohi 1991 paper state that US economy faced slowdown not because of the oil price shock, but because of the Fed reaction to oil price shock. So this implies there is even a negative consequences of central bank reaction to oil price shock. Hence, a very considerable decision need to be made. We see there is a two-way relationship between oil price and interest rate depending on the type of oil shock. Although there's very less literature on the role of monetary framework in this oil interest rate dynamics, there's paper by Clarida and DeLong which mentioned that monetary response to oil price shock is heavily dependent on kind of monetary framework country follow. In the same context, Newman state that for developed country, central bank following the IT framework, and if there is a oil price shock in that economy leading to inflationary pressure in an economy, then central bank can control that situation with much less increase in the interest rate. On the contrary, Phillips papers state that in that situation, central bank actually react excessively quickly by increasing the interest rate to keep the credibility of the framework intact. So we see two different opinions regarding the monetary framework. And then in the other line, we have Chu and Sek paper, which say that oil price does not induce monetary reaction at all in the long run for Thailand. So we see that there is not, as presently, there is not enough evidence to conclude whether how does a central bank react to oil price shock while operating in IT framework as compared to non-IT framework. So we have adopted the famous Taylor rule given by John Taylor in 1993, a thumb rule for setting interest rate for central bank. In equation 1 state that when the actual output increases the potential output, or the inflation increases the desired inflation, central bank react positively by increasing the interest rate. There was some argument that since the economies are opening up and open economy are subjected to external shock, even exchange rate should also be part of interest rate setting. So we have open economy Taylor rule in equation 2, where ET capture the exchange rate movement, alpha, beta, gamma are the weight assigned to the respective deviation. Now, in recent empirical study, this equation is further augmented with the variable of interest, like we have Hafner 2017 paper, which have included asset price in the Taylor equation. Similar included international reserve in the Taylor equation. So in this paper, we intend to estimate the below argumented Taylor rule with the crude oil price in the panel data framework, it is very reasonable to assume that the central bank might react to crude oil movement for this oil importing country because of their heavy dependence on imported oil, and also because oil have an implication on the growth and inflation. So the final model of this paper is policy rate equal to beta naught plus beta 1 output gap, that is division between actual and potential, beta 2 inflation, beta 3 exchange rate, beta 4 oil price, beta 5 IT, that is a dummy variable which takes value 1 if the country follows inflation targeting framework at any time, otherwise 0, and beta 6 interaction term between dummy and oil price. Here we expect the coefficient of output gap and inflation, that is beta 1 and beta, to be positive and significant, which is in line with the theoretical Taylor rule. For exchange rate coefficient, beta 3 can either be significant or is not significant, depending on how important role exchange rate plays in this economy. So there's two parts of the literature. First part by Rajan and Mohanty state that exchange rate plays a very dominant role in the emerging economy, as it decides the competitiveness of tradable good and also for financial stability. Hence, it has been observed that central bank try to stabilize the exchange rate via monetary instrument. But the another part of the literature by Taylor and Rogoff state that the direct response to exchange rate fluctuation via altering the interest rate need to be muted, and that will further worsen the macroeconomic scenario. And moreover, we can manage the exchange rate fluctuation by movement in FX reserve rather than altering the interest rate. For the coefficient of oil price beta 4, it can again be positive or negative depending on how the oil price shock comes in this economy. But we expect beta 4 to be positive and significant, as said that the negative supply shock in oil importing countries is dominant, and we expect the central bank will react positively in order to make sure negative supply shock does not become a demand shock in long run. And we will see how beta 5 and beta 6 comes up. This slide talk about these data sources. So our study is for 5 Asia oil importing Asian countries of India, Thailand, Vietnam, Indonesia, and Bangladesh. The classification of this country as oil importing is based on WTI's data, and as emerging economies is based on IMF data. We have used monthly data from 2008 to 2019. For output gap, we have used HP filter to calculate the potential output. The below table talks about the exact variable name and the source from where it has been taken. For interest rate, we have central bank policy rate from IMF IFS. For inflation, we have CPI percentage, some previous period IMF IFS. Output gap is IIP or manufacturing index IMF IFS. Exchange rate is in dollar, end of the period IMF IFS. Oil price is Brent crude oil, spot price in USD per barrel. We have taken Brent crude price in our model because it is considered to be a most uniform substitute for the oil price that is taken from USEIA. We have also taken WTI, West Texas Intermediate Spot Price, to do a robustness check of our model. And the classification of the country as inflation and non-inflation framework is based on IMF ARIA report that the dummy captured that framework. There were two main issues regarding data. First, we have used the unbalanced panel data set because of the data limitation. And since monthly GDP is not available, we have used IIP. And only the case of Indonesia and Thailand, even IIP was missing, and we have gone with manufacturing index. Then we move forward to do some panel diagnostic tests. We make sure whatever tests we use are very much appropriate for unbalanced panel data set. We started with cross-sectional dependence and homogeneous test. It is very important to see whether potential external factor might influence our result. So we have done Pearson and Magenta homogeneity test and Pearson CST test, and we find, yes, there is a cross-sectional dependency in our sample with heterogeneous slope. We then move forward to do a panel unit root test, and we have done Fisher ADF and chi-square test, which is very much appropriate in terms of cross-sectional dependency and heterogeneity. And we find our variables are stationary at I1. Then we wanted to see if there's a long-run relationship among the variable, and then we move forward to do Vestal and panel co-integration test, and we find that yes, there is a long-run co-integration among the variable. Hence, our sample is cross-sectionally dependent with heterogeneous slope and existence of long-run relationship. when there is a long run relationship in the variable, there is a high chances of endogeneity issue among the variables. So we have used fully modified ordinary least square FMOLS and dynamic ordinary least square DOLS estimator because it's correct for possible endogeneity issue in the model. It's also correct for serial correlation in an error and eliminate the sample bias. It is very much capable of handling cross-sectional dependency with heterogeneous slope in the sample, and thus it provides an unbiased, efficient, and consistent estimate. Since it do not provide a two-way linkage among the variable, we then move to do a panel causality test in order to understand a two-way linkage among the variable of Taylor rules. This slide talks about the result we got, but before moving to discussing the result, we have 3 points. First, our results are consistent using both the method of estimation, that is FMOLS and DOLS. Also, our results are consistent using Brent crude oil price and WTI oil price. And thirdly, our results are consistent even using log in the model. We have not used log in our main model because this transformation of the data in the linear form, actually the actual value of data despair, but anyways, our results are robust using log also. So moving to the coefficient, we see that inflation and output coefficient is positive and significant, which is very much in line with the theoretical Taylor rule that the central bank react positively to inflation and output gap. For exchange rate, we see that variable is significant, but the magnitude is very less, that is 0.0002. This validates the premises that the diet channel, that is diet reaction of central bank to exchange rate fluctuation need to be muted, as that can further distort the macroeconomic scenario. For our variable of interest, oil, we see that it is significant and positive, which again validate the premises that oil importing country face a negative supply shock, and hence the central bank react positively by increasing the interest rate to make sure that the supply shock does not become a demand shock. For dummy variable, that is inflation targeting framework, we see it is negative and significant, which implies that the inflation targeting is associated with lower interest rate setting as compared to non-IT framework. Our main variable of interest, that is Brent crude oil price and the interaction term, we see that the central bank react differently to oil price shock while operating IT framework as compared to non-IT framework. So basically, central bank react less aggressively to oil price shock because of better anchoring of inflation expectation and conduct of the monetary policy, and less aggressively to oil price shock. I then move forward to do a two-way casual linkage among the variables.
You have 2 more minutes. Maybe you can quickly summarize your results.
Yes,
Okay,
sure.
please go on. Because I have already 3 questions. So try to conclude your paper. Maybe you can take 1 or 2 minutes more because there are fewer questions here.
Okay, so this slide talk about the two-way linkage between the variable, and this is like oil price lead to inflationary pressure in economy, and this is in line with Taylor rule. I move forward, this inferences are already talked about. I move forward to conclude my paper. So we have basically investigated the oil price shock response to oil importing country of India, Indonesia, Vietnam, Thailand, and Bangladesh. And we see that oil plays a very important role in the setting of the interest rate as level of inflation impacted. We answer the question, yes, monetary framework plays a role. And also we answer the question, yes, central bank react differently while operating IT frameworks as compared to non-IT framework. Under IT, central bank reacts less aggressively by setting a lower interest rate as compared to non-IT because of better anchoring of inflation expectation. Thus, the negative impact that the monetary response can have is effectively contained in IT framework. Finally, this paper asserts that the country should strive to follow a credible framework like IT framework in terms of absorbing sudden and unprecedented oil shock. In this way, oil importing country can successfully maintain the macroeconomic stability without compromising on growth. Thank you. And I'm happy to take questions.
Yeah. Thank you indeed. Thank you indeed for sticking to the timeline. So you have, so far you have around 4 questions. One is just clarificatory, which is saying that which inflation targeting you are talking about. It is from basically inflation targeting in India started from 2016 onwards. Why you are referring to 2014 then? The second, and Okay, just take down the question, maybe then quickly you can respond, because I'm sure that there will be some overlapping of the questions. So the
Okay.
second and third question is from Professor Sengupta, who is raising very pertinent questions here regarding two are basically on the IT framework and on equation. So let me read out the questions. Yeah. So basically, why are you not controlling for the lagged policy rate? It is quite common in the Taylor rule, right? Which is called the inertia component. So then the lagged policy coefficient is not there in your model. In most of the time, this becomes very, very significant, and some of the coefficient loses its significance there. So any particular reason why you are not doing that? Secondly, she
Okay.
also had the question that what is your inflation measure? It is core inflation or headline inflation? And why are you not using the inflation band? And thirdly, why not T-bill rate, 91 days T-bill rate when you are doing so? Okay, maybe you can quickly answer those, and I see a barrage of questions thereafter. So be brief in your answers.
Okay, so the first question, the classification of this country as inflation targeting is based on IMF IR report. According to IMF IR report, India shifted to inflation targeting 2014 when the Raghuram Rajan might have been initiated the program, and hence India got classified as inflation targeting framework. The second question, we haven't included the policy initiative, that is interest smoothing variable in our Taylor equation, because we are using a monthly data set, and this the smoothing pattern become very negligible. And moreover, we are using FMOLS and DOLS estimator, which takes into account the dynamic nature of the variable, and if there is any policy initiative, it will take into account. Thirdly, we are using the headline inflation because central bank react to CPI as an and consider CPI while moving interest rate. That is a main measure. That is why we are restricted to CPI.
So thank you. In there are a few more technical questions, like say FMOLS assumes cross-sectional independence. So have you kind of deferred the data? And Rajeshwari asked that this was the same period with low inflation, sorry, low oil prices. So have you taken into account that? What is your thought in that? And then quickly to Shushanta's question that, yeah, I know that the time is almost over. So quickly to Shushanta's question that whether the policy rates, why there is one unidirectional causality. And then I have one more question from Ashima madam, but you quickly respond to this question, then I'll go to Ashima madam's question.
Saurabh, she has time till 5 o'clock, so there is time.
Okay, no problem.
Yeah.
Fine.
Okay, so for first question, the
Okay,
FMOLS.
Ishika, you can please go on.
Okay, so for the first question, the FMOLS and DOLS estimator takes into account the cross-sectional dependency among the variable, and correct for that, it is very much of capable of handling CST issue. For second question, that the period of 2008 and 2019, so we have not only seen the oil price falling, but oil price also rise during this period. So this period was like oil price rise also, fall also. So I mean, this is not the one side effect of that. It's consider both the oil price fall and rise. For policy rate, so sorry, what was the question for last one? Policy rate?
So
Can you please
basically the
repeat the
question, yeah, basically the question from Shushanto is why you are getting unidirectional causality? Why, what could be the reason for that?
So as I said that even there's a negative consequences of central bank reaction to the oil price shock. As I discussed that with the US background, where the Bohi said that it was not because of the oil price shock that the economy faced slowdown, but it was because of central bank reaction. So this implies that even there's a negative consequences that might happen because of the central bank reaction that might worsen the economic oil price reaction. Hence, we see that unidirectional relationship among policy rate and oil price.
Okay, now Ashima madam has a very important question. It most probably refers to your slide 3, which says that central bank response reduces the fall in demand from a supply shock. Now, a rise in interest rate by itself can reduce the demand, right? And why you are saying that the central bank is responding to this fall in demand? Actually, central bank reduces the fall in demand.
Sorry, I didn't get this question. Can you please?
So, Ashima madam, would you like to ask this question? Can Ashima madam ask? It is
Yeah, it'll just take a couple of seconds because then we'll just have to change the status to co-host. So while Abhishek is doing that, let me just, Ishika, so what you've done is you're taken a headline inflation measure and you also have oil prices on the right hand side.
Right.
The head measure of headline inflation itself has oil price in it,
Right.
right?
So,
Wouldn't that affect your result in some way?
so
And the other, even if you're doing dynamic OLS, I'm not clear, are you explicitly controlling for the interest rate inertia on the right hand side? So you should just maybe just do a panel OLS with the interest rate lagged on the right hand side and see how the significance of the other coefficients is getting affected by that, because a very strong persistence in emerging countries.
okay. For the first question, that inflation already takes into account the crude price. So that can result in the endogeneity issue, that the variables are highly correlated. And we have used FMOS and DOLS to make sure that this endogeneity issue is very much taken care of. So this is taken care of. And second, okay, I thank you for that suggestion. I will do the panel OLS and see my result.
Professor Ashima Goel, you'll be able to unmute
Yes,
yourself now.
yes, Ishita. Good attempt at estimating these coefficients, etc. But when you were talking about your motivation, you said that central banks react to a supply shock because later on it can become a demand shock. So to prevent that. But if a central bank reaction is a rise in interest rates, it would itself be a demand shock. No, it would itself reduce demand. So what is the logic there?
So basically what I'm trying to say is that since oil is major input in the production process, and that is leading to inflationary pressure in the economy, the input of oil leading to inflationary pressure in the economy. So if the central bank react to inflationary pressure at the right time, then it will not lead to a demand shock. That is effectively contained in that movement itself. So
No, but how does the central bank react? Just tell me. The central bank raises interest rates.
Right. So in this way, the inflationary pressure is controlled.
What does an interest rate have on demand?
Yes.
What impact does an interest rate rise have on demand?
Okay, so I am looking at from the supply channel where I'm telling that interest rate rise will help in reducing the inflationary pressure in an economy, basically. So
But how?
that demand.
But how? Even on the supply side, an interest rate is raises costs. A rise in interest rate raises costs of working capital and so on. So I'm just saying you need to think about this.
Okay.
Be careful in making such statements. Okay.
Okay. Yes.
Yeah, Ishika, please take a note of this one. This is a very important point Madam has raised. So maybe now we can move over to the next paper, which is on communication and stock market volatility evidences from India. May I request?
Saurabh, yeah, before that, I think Neha Verma also had a suggestion because there is still about 1 minute left. So that's something
So
that.
she is referring to a paper. We can share that paper with her.
Right.
Basically, this is not a question. That is why I didn't ask that question.
Right.
Of course,
Fair
you can.
Yeah. So both Neha and Professor Sushanta Malik have suggested 2 papers that we can send.
Yeah, that we can
Ishika.
send,
Yeah.
but those are not questions, basically.
Sure. Okay, let's move it. Yeah.
Thank you for your comment and suggestion.
Thank you. We will. There are 2 papers. Maybe we can share these papers with you from the chat. Okay.
Yeah.
Okay. So maybe we can now move over to the next paper, which is on central bank communication and stock market volatility. And may I request Suruchi to kindly present this paper? Again, the same set of rule applies, 20 minutes and 10 minutes discussion. Suruchi,
Thank you, sir.
over to you.
Thank you. Am I audible?
Yep.
Okay, good evening, everyone. I'm Suruchi. I'm here to present a paper authored by me and Dr. Wasim Ahmed. It is titled as Effect of Central Bank's Communication on the Stock Market Volatility. So this is the overview of my presentation. In the first part, I'll talk about some literature and draw out the objective of the study. And in the second part, I'll talk about detailed empirical procedures and major findings, and finally conclude. So the very first question is, what is communication link of monetary policy transmission? So central bank have multiple goal of maintaining price and financial stability, and along with that enhancing growth. And they do so by acting upon operating targets through various instruments. But lately in 2 decades, communication has been emphasized a lot as a monetary policy tool. But this was not the case always. Before 90s, non-transparency and secrecy were common attributes to central banking. And Brunner went on saying that central banking as an exotic art, which is accessible only to elites. And Ryder wrote a book which described Fed's policy formation and titled it as Secrets of the Table. So this was the kind of air surrounded central banking that time, but it started changing when Fed started issuing statement and rationale behind its decision. And when ECB was established in 98, it adopted fairly transparent communication policy to garner support from various countries at that time. So benefits are associated with effective communication policy, which are as follows: like it ensures accountability, it showcases commitment to stability, and it also helps steer market expectations. So our main focus would be here on third point. So coming to the literature, we have divided it into 3 parts. First one is how central bank's communication manages expectation. An important paper to quote here is of Blinder et al. They said that in a macroeconomic setup, communication can make a difference if any of the 4 things exist. First one is if the policy rule and the economic environment is not static, if there is learning opportunity, if expectations are not rational, or if central bank possesses some superior information, which is generally the case. So they also emphasize that central bank manages expectation by creating news and reducing noise. So the majority of empirical literature actually revolves around these 2. Jagdish Wu and others actually established that communication does offer market moving information and affect volatility in return of asset prices. And Rosa and Berger, others, they explored that communication actually improves monetary policy predictability. So coming to the second strand of our literature, when we talk about communication, it is very important to know how communication as a variable developed, because it is a latent variable in the throughout the literature, and where does textual analysis comes in picture, which is the major methodology used in the paper. So Korn and Seck and others actually did basic volatility analysis, in which they found that volatility was more on the communication days as compared to normal days. But this kind of analysis only ensures announcement effect and does not talk about direction of the effect. So Rosa and Berger and others took this task and they manually coded the central bank statement into various grid of hawkish and dovish categories. But this kind of analysis again have the problem of subjectivity and non-reproducibility. So there came textual analysis, and these authors actually used textual analysis to quantify content and basically quantify communication variable, and with various methods, which I'll be discussing in the methodology. So coming to Indian studies, how far we have reached, an important study to quote is of Mathur and Sen Gupta. They have analyzed a very interesting, you can say, feature of text, which is linguistic complexities, readability, and lengthiness of monetary policy statement, and found that it has significant impact on volatility in currency market and equity markets. Anand et al. Has done a study with they have studied the impact of tone of speeches of central bank of 5 emerging economies, which included India. Goel and Parab actually they quantified tone using AVG dictionary and analyzed its effect on inflation expectation formation. So what is novelty of our work? We undertake detailed content analysis of monetary policy statement, and we use advanced methodology to quantify text with extensive robustness check as compared to the global standards in this literature. So coming to RBI's communication have been fairly transparent. This is how it evolved. I'll not talk about this and skip. RBI's main communication is based on communication policy document of RBI, which is updated June 2021. The main feature is it refrains from giving any forward guidance. Rather, information is open for interpretation for market participation. participants. So the major focus of component they focus on is rationale behind their decision and assessment of the economy. So why RBI's communication is important? It is important, I'll quote the policymaker themselves. The then Deputy Governor Rakesh Mohan said that since the economic system is becoming complex, it is not flexible use of indirect instrument can be done. Then Rajan emphasized that it helped ease the reforms. And then again in a press conference, Rajan said that RBI is neither a hawk nor a dove, but an owl. And Urjit Patel extended that by all they mean RBI possess wisdom, and they are vigilant when others are sleeping. So this actually suggests that superiority of information is there with the institute. So this warrants an inspection into their communication policies. So the objective is to quantify RBI's communication variable using text analytics approach and to analyze its effect on market expectation in the presence of informational, financial, and macroeconomic controls. This brings us to the empirical procedures. So while doing the research, we have various questions. The very first one is to which data to choose. Central bank communicates through various modes like circulars, press release, speeches, and others, but we chose monetary policy statement because they are more focused on topics and they are very timely in nature. We use 70 qualitative MPs from July 2010 to December 2020. A note is in order since there is a structural change from June 2016. The developmental and regulatory policy was published under MPS before June 2016, but it is published as a separate document now. And we had two data choice for consistency, either to remove this DRP section from MPS before June 2016 or combine DRP section with MPS after June 2016. But we chose later option so that there is no informational loss, and results for former choice is also very consistent. So now we come to the choice of methodology. We'll be using textual analysis, and in that we'll be using dictionary-based method. What does dictionary-based methods do? They analyze tone of the document based on predefined sentiment associated list. Now the question here comes whether to construct our own lexicon or to adopt from a well-established literature. Schedling and Wagner actually ill-advise again constructing own lexicon because it may result into hindsight bias as same data is used twice, and a lot of control is given in the hands of researchers. So we refrain from constructing our own lexicon, and we adopted LM Dictionary given by Longren and McDonald. It is a finance field specific dictionary. This came because general dictionary perceive many financial terms like cost, taxes as negative. So it has 6 lists, negative, positive, and others. We'll be majorly using negative and positive lists. Now the thing is how to construct the measure. So there is one more approach of bag of words in which word to word, each word is treated as a data point and word to word search is made. But in this kind of analysis, context is lost. The context in which that word is used is lost. So we refrain from using this. Then to improve over this, FL and Blix Remeldi actually use the n-gram approach. By n-gram, we mean n can take any number. In gram, we mean word. So if we take 2, then we 2 gram by gram actually analyzes 2 words at a time. So they actually constructed a dictionary based on central bank's goal and selected terms like inflation, economic growth, and along with adjectives like increase and decrease and others. So then they made permutation and combination like increased inflation actually is a hawkish language, decreased inflation is a dovish language. This is how they constructed that dictionary. But n-gram approach also have a caveat that it does not account for valence shifting terms. So what are valence shifting terms? It has 4 lists: negators, de-amplifiers, amplifiers, and adversity conjectures. Negators, I'll explain this by example. Suppose isn't is a negator and good is a positive word. So it is used in a sentence. It is good. So if isn't is present, like it isn't good, then it negates the positive meaning of good. And see, if de-amplifier hardly good, that means the positivity is actually demeaned for a degree. And if amplifier is like very good, then we actually amplify the meaning of goodness. And when we use adversative conjunction like but in a sentence, if it is present, so suppose it is very good, but it doesn't matter. So the phrase before but actually was given less weight. So these kind of linguistic intricacies have been taken care. We have constructed two measures. First, we have used the normal unigram approach, bag of words approach, in which we counted number of positive and number of negative words and constructed a ratio of their difference with total words and found tone uni. Then second approach is valence shifting cluster approach, in which we'll take valence shifting words into account. We have adopted this methodology from winter 2019. In this methodology, the document is first divided at a sentence unit. Now, each sentence is treated as a document. Then pre-processing steps are followed to clean the data. And then the major part is this. So what is a polar word? Polar word can be positive word or negative word entering into the positive or negative list, which is associated with some polarity. We pinpoint that word. Then we construct a cluster around it. How we construct a cluster? We take words from P-5 place to P+2 place. This actually captures the context in which that word is used. While constructing the cluster, we actually take care of linguistic intricacies such as commas, semicolon, and colon, which actually indicates change in idea. So, so if at P-4 comma is occurring, then we'll take from P-3 to P+2 like this. Now, this is a formula in which all the things are entering, negators and others. I'll explain this. S is the polarity score. It takes value +1 when it is positive and -1 when it is negative. Negators do two things. It flips polarity sign and it converts amplifiers into de-amplifiers if the negators are odd. If negators are even, then negation is nullified. It is assumed that negation is nullified. Amplifiers upweight polarity by 0.8, de-amplified downweight polarity by 0.8. Adversative conjunction put less weight on phrase before than after P. So AC is the difference between number of adversative conjunction before polar word and after polar word. So neutral words are also taken into account. They enter into the word count. This is the word count of the sentence, and this is the sentence level tone. So after deriving sentence level tone, we sum it up and divide it by number of sentences to obtain the document level tone. So this gives us our measure, which both the measures are plotted here. Let's get this. This is a very interesting graph, lexical dispersion graph. You can take it as a summary. The column present the term we are analyzing and row present the documents in a time series. And this lines actually present the exact position of that word in the document. So you can see that over the time, and starting from the Rajan's time, the monetary policy statement have been structured. The word inflation and growth have been used at specific place only. So this is where framework change can be seen, and many more inferences can be taken, but I'll skip for now. These are the word clouds, and coming to the empirical design, India VIX NSE is our dependent variable expected market volatility over the next 30 days. We have taken this, we have written T plus M subscript because T is the announcement date and M is the for subsequent days we are testing the volatility is affected by tone or not. This is done so that we can see that is there any informational integration lag in the market. Now, statement release affect due to two things: policy rate change surprise, quantitative, which is quantitative, and tone of rational. So to control for this, we have taken monetary policy surprise variable. What is that? Monetary policy surprise variable in literature is measured by movement in price of interest rate futures contract, but in Indian context, it is not valid because futures contract are not traded in volume. So we have used OIS rates, which are forward-looking in nature, as they facilitate exchange of fixed interest rate for variable interest rate payments. So they are speculating the decisions actually. So other validating literatures are this, and we have taken absolute change in OIS 3-month rate from a day before the announcement to the day of the announcement. And why absolute change? Because surprise can increase volatility in any direction. Suppose we are expecting a change, but central bank doesn't change the rate, then that comes as a surprise to the market. So we have taken absolute change. Other informational control is of inflation expectation survey of household, which is released on the day or before a day before announcement. So we have taken expected 3-month ahead inflation rate to control for this information. Then we have taken dummy controls like COVID dummy, hypothesis is general increase in volatility due to COVID, framework dummy, a change in procedures and increased transparency resulted in lower volatility. And financial and macroeconomic controls include growth of IIP and year-on-year inflation rate, real effective exchange rate and foreign institutional investment for external sector, and Bloomberg Commodity Return Index representing global commodity prices. So these are the descriptive statistics, and this is a plot of measure and volatility. We can see negative association. So coming to the results, we have modeled into, we have actually run two models. In first model, we have included informational and dummy controls only, and then the full model is done for subsequent 2 days and for both the tone measures. So we can see that tone measure is negatively associated and negative and significant throughout all the models, and monetary policy surprise is significantly explaining the volatility. COVID dummy is positive and significant, which is with our hypothesis, and framework dummy is negative and significant, which also validate our hypothesis. IIP and inflation has expected sign and are significant in explaining the thing, and foreign institutional investment is also explaining the volatility. So we can see that there is information integration lag as the tone variable is significant for subsequent 2 days. So financial market is not very efficient, and the reason for this is maybe because a lag of information dissemination through media and other involvements. So these are the basic results, and we've got consistency in our results. So coming to the robustness check, we have done 3 robustness check. Media content-based EPU, we have constructed litigious ratio from MPS text, which is equal to, which is a ratio of number of litigious word in the document upon total word in the document. This is done because DRP indicate regulation on financial market. And we have also included a quantitative policy rate change, though we have included surprise element, still for a robustness check, we have included this. So results are robust to these variables, and we can see that here quantitative policy rate change is not significant in explaining the volatility. This is due to the presence of this variable. So in conclusion, successfully quantified tone of RBI's communication from unstructured qualitative data, and RBI's communication matters and its tone moves the market. Information is not integrated immediately in the financial markets, so there are intermediary informational disseminations are there. So work in progress, we are right now constructing a dictionary suitable for RBI's communication, specific how RBI talks, and we are exploring predictability aspect of monetary policy decision, and along with that evaluation of tone of members of monetary policy committee. So these are the references. Thank you.
Okay, thank you indeed for completing your presentation within time. I can see a couple of questions in the chat box. So to start with, is the chat box also, can you
yes sir,
okay,
it's
so
visible.
as you can see, Ashima madam has asked for including the suggested inclusion of a forward guidance measure, as expected interest rate path has also some implication on stock market volatility, you know. And then I have Professor Shengupta's question, which is how would you explain the sign of the tone coefficients in your estimated model? Because one can argue that it can go either way. So maybe you can answer these questions, and then we go forward to the next round of questions.
Yeah, coming to the first question, I think forward guidance, by forward guidance, they mean some expected variables, future predicted things, right? Am I understanding the question right? The expected interest stock market. So I have expected interest rate path there is to deal with this, I think there is a data problem. I think availability of data is not there on this expected interest rate path. But yeah, if it is, it would be very nice. It will improve the model if we can include forward guidance measure as well. So I don't know. I understood the question or not.
Okay, so maybe
Yeah.
Madam can. Yeah. So let us move over to the next questions. If this is.
So yes, Professor Singh Gupta's question is about the sign of how could you interpret it. Okay, so this is what we get. It can go either way as well for volatility, but this is the established result in the literature that volatility actually is more when the tone is negative, and it is less when the tone is okay, positive, and central bank is optimistic. It is not about optimistic about certain thing. It is the overall tone of the document. When we do contextual analysis, like if we are only talking about inflation, if we are talking only about output or growth, then in that case, I think hawkish and dovishness can actually come into picture in case of central bank, and we can evaluate it through that perspective. But we are right now looking at the feature of overall sentiment of the document. So I think throughout the literature, it is the same, and you're right, it can be go either way, but that is context dependent.
Okay, so Vavik has the next question where he is basically asking about the introduction of algo trading. So have you control for introduction of algorithmic trading, because it has changed the volatility significantly, number one? And if I understand correctly, the second part of the question is talking about the duration of the volatility. How long is this volatility lasting?
Yes, that is what we are saying. That is where we took the integration of information thing, where we are testing the effect on next 2 days also. So we can see that in Indian case, which is not the case in foreign countries, market is quite volatile after 2 days, after 2 days of the release of the document. But this is I think this is because most of the market participants do not take the perspective from the direct contact point, but through the media. So there is a role of media in there. And to the first question, I think about algo trading, I have not control about that. There is no control regarding that, but we can see how it can be incorporated in the model. And I can see Professor Sen Gupta, yes, she has said that forward guidance shock we using higher maturity or ISL. Yes, we can actually include that. And actually, I have done that for OIS rate. We have 1 year and 5-year maturity. I've tested that also. It is coming out to the same.
Yeah, so I have 2 questions, because this is very close to all of us in RBI, that how the communication is impacting the stock market. One question is about this 2 days that you are saying. You know, most of this time the policy was announced on Thursday. So if say it is Thursday, then you have the weekend in between. Have you control for the same, whether the weekend is coming in between when you are talking about 2 days? Means, is it the Monday? If the Mondays were there, the volatility was more. And the second question is relating this YS rates that you are using. Like, say, if you are using YS rate, then what maturity? What Professor Sengupta also coined in one part of the question. What maturity? Because many of these YS segments, including, I think you are using that's my question. Why you are using 3 nights? Because sorry, 3 months. Because there are 1 month YS rates also, and the most liquid YS rate is 6 months. So what kind of prompts you in using this 3 months YS rate?
Sir, basically, the time period I've been analyzing, the structure has been changing, and the timeline is also changing, the release dates. So I've actually tested with all the combinations. OIS is coming out significant every time, but I have personally chosen 3 months for based on the rationale that the frequency of statement is actually somehow on average is differing, coming out to be 2.5 or 3. You can say now we have started bi-monthly statement, but before that we used to have quarterly statement and then a mid-quarter review in between. So to see that how market participants are actually speculating for next 3 months when another statement will come in picture. So I've done that. We can also use 6 month and 1 month. I've tested with that also.
Okay, so Jyotsna has a point that media also mediates the market effective volatility, you know. So have you kind of tried to analyze that how media is representing the entire policy in a way that is impacting the market?
So this was not the objective of the study. Actually, we were actually focusing on the center of communication. But yes, we have, through our analysis, we found that this integration lag may be due to market participants are dependent on media perspective. So media is actually affecting. So we'll be answering this question in coming works. We'll be answering this, but in this paper, I don't think so there is anything about it.
Okay, so Professor Sangupta has another comment that the choice of liquidity has to be basically liquidity based. 6 months is the most liquid, so using 6 months may be okay. But then otherwise, if you are talking about the short-term surprises, then perhaps you should use 1 month's YS rates.
Thank you for the suggestion. I've tested for these and results are significant. I've not presented it in tables. I'll see that. I'll go through this reasoning.
Okay, so I do not see any more questions in the chat box.
Saurabh, as co-host, I'm just going to exercise a bit of privilege.
Yes, sure.
So the other thing is that, Suruchi, if you look at stock market returns instead of volatility from a sentiment or a tone perspective, you might actually end up getting more interesting results, because with volatility, as you're doing a document level tone analysis, fair enough. But if you just look at stock market returns in addition, my sense is that you might get some very interesting results, which would be more interesting to analyze. And the second thing is analyzing the contextual tone in context of inflation or GDP growth for emerging markets, central bank like RBI is perhaps more interesting than looking at the document-wise tone. Because what happens is, particularly if you go backwards, the RBI monetary policy statements are discussing a plethora of issues. Because as you said, the development and regulatory practices was also part of monetary policy statement. Whereas if you just narrow down on the inflation and growth-based tone, the sentiment, then analyze that, the effect of that on the stock market returns, I think that will just really sharpen your analysis a lot more. So that would be my suggestion.
Yeah, thank you, ma'am. Actually, this is in the pipeline right now. Through this analysis, we actually found that yes, it does. The tone affects, but to dig deep into it, we tried to do contextual analysis. But as the established literature of AVG dictionary is not very valid for India, because it is based on US documents. So we are right now calibrating a dictionary which is actually representing the communication of emerging markets and topics which are important for emerging markets. So we are actually working on that. It is in pipeline right now.
And I think Apika Sharma has a question that the survey of professional forecasters data is probably a better bet for using rather than using household expectation survey.
Yes. We can also test for that also, because that is also released on the same day. We can test for that also. And it has expected inflation and repo rates also. We were planning to do that, include that for our business.
Okay, over to you, Saurabh.
Okay, thank you, Raj, for pointing out these two questions. Perhaps I have missed this too. Okay, so we are so far on time. So can we please move over to the next presentation, which is again on commodity prices, but which takes a kind of a different look into the inflation and commodity price dynamics. So over to you, Rudra.
Thank you, Chair. Am I audible?
Yeah, please go on.
Can you see my presentation?
Yes, yes.
Okay. Good evening, everyone. The paper that I'm going to present today, the title of the paper that I'm going to present today is Forecasting Indian Inflation Using Commodity Futures Prices, the Role of Asymmetries and Structural Breaks. This is part of my PhD thesis, and it's jointly written with Professor Shoikat Sinoray from Jadavpur University. So this is the broad outline or structure of the presentation. So firstly, I will try to give you an overview of the topic. Then very briefly, I shall try to discuss about some stylized fact of inflation in India. Then I will discuss about the methodology and data that we have used in this study. Then I will show you the results that we have got. And lastly, I will summarize and talk a little bit about the contribution of this study to the literature. So here the objective of the study is threefold. Firstly, we want to check whether augmenting traditional Phillips curve type model with inclusion of supply side factors such as crude oil prices can produce better inflation forecast or not. Secondly, we want to check whether augmenting traditional Phillips curve type model with inclusion of commodity futures prices instead of crude oil prices can produce better inflation forecast or not. And lastly, we want to check whether it is important to include structural breaks and asymmetric price changes when we are modeling inflation in India. Now, as we all know that many central banks across countries have adopted inflation targeting as their monetary policy framework. In 1990s, central banks in most of the industrialist countries adopted inflation targeting, while in 2000 and thereafter, emerging market economies have adopted inflation targeting as their monetary policy framework. In India, the Reserve Bank of India has adopted inflation targeting in August 2016. Now, when a central bank is practicing inflation targeting, it basically estimates and makes public the what is called the projected or target rate of inflation, and then they attempt to divert the actual rate of inflation towards the target or projected rate of inflation using their monetary policy tools. Now, what actually central bank does, they actually compare the actual rate of inflation with the forecasted rate of inflation, and accordingly they set their monetary policy tools. So for the central banks practicing inflation targeting, it is very important to produce accurate inflation forecast. And for that, what is important is to find out the determinants or drivers of inflation. And these determinants or drivers may vary largely across economies. Now, in literature, the most common or most famous model of inflation is the Phillips curve type model, where we link inflation with the output gap. Now, of late, many studies have started including supply side factors such as crude oil prices in the Phillips curve type model. And also there are many studies which that have found that commodity prices is a leading indicator for inflation and thus has a very important role to play in monetary policy making. Now, this is mainly on account of two facts, that these commodities are used as raw materials in the production processes, and thus these commodity prices react to supply shocks. And secondly, since these commodities are traded in auction markets or derivative markets, they react to the commodity prices react to demand and supply shocks, and these commodity prices signals about the future state of the economy. Now, arguing in the same line, in a theoretical model, Shocking and Xiang have shown that the effect of commodity future prices on inflation can be decomposed into two effects: the cost effect and the informational effect. Now, the overall impact of the commodity prices on inflation is determined through the relative strength of these two effects, cost effect and the information effect. Now, coming to the relevant literature survey part, actually we have some studies on inflation forecasting using commodity prices or crude oil prices. Some of these studies are for developed countries and some others are for emerging market economies. Now, we have attempted to find out the relationship between commodities, future prices and inflation in India, in an emerging market like India. And one may ask me that why it is important to model the relationship between commodity future prices and inflation in an emerging market economy in contrast to that in a developed country. The answer can also be found in literature, where it is found that the relationship between commodity future prices and inflation has become weaker over time for developed countries, and the same has become stronger over time for emerging market economies. That is why we can see here that in the recent past, many studies have attempted to study the relationship between crude oil prices or commodity future prices and inflation in emerging market economies like South Africa, Nigeria, etc. Now, if we want to understand the evolution of inflation in India, we need to understand the different phases of monetary policy in India. In the post-independence period, Indian monetary policy has gone through mainly 4 phases of control expansion, monetary targeting, multiple indicator approach, and flexible inflation targeting. Now, in some of these phases, inflation was high. In some of these phases, inflation was relatively low. So that is why it is important to consider structural break when we are modeling inflation in India. So from this figure also we can show that there is presence of structural break. If you consider the inflation from January 2006 to June 2019, that is our sample period. So using the biparent test, we have found that there are at least 4 structural breaks during this period. So now, since RBI has already adopted for flexible inflation targeting as their monetary policy framework, it is important for them to predict inflation accurately. Now, studies have shown that RBI's inflation forecast is as good as that of the central banks in any developed countries at least in terms of accuracy and unbiasedness. But modeling inflation in India is very challenging, especially due to the fact that there is a large share of food items in the CPI basket for which the price is very volatile. Now, coming to the methodology part, here to find out the relationship between commodity future prices and inflation, we have used this feasible quasi-generalized least square technique proposed by Westerlund and Narayan in 2012 and later on modified in their 2015 paper. So we are using this methodology because this methodology can handle if there is presence of endogeneity, persistence, or conditional heteroscedasticity. Now, this is the basic model that we want to estimate. So here the dependent variable is inflation, and the X is the predictor variable, which is also a leading indicator of inflation. Now we want to test whether this beta is equal to 0 or not. This test is called the predictability test. Now this predictor variable can also follow a first order autoregressive process, or there can be a problem of persistence. Now there can also be problem of endogeneity. Now we can check whether there is endogeneity or not using this Westerlund and Narayan 2015 test. So what we do, we regress the error series from the first equation on the error series of the second equation, and we check whether this gamma is equal to 0 or not. And if we find that the gamma is significantly different from 0, then we say that there is a problem of endogeneity. Now, by incorporating equation 2 and 3 in equation 1, we can solve, or we can eradicate the issue of persistence and endogeneity in our model. So then we estimate this adjusted model as proposed by Westerlund and Narayan in their 2015 paper. And then the last problem to deal with is the problem of heteroscedasticity, for which we use the GLS technique. And for the GLS technique, we use the conditional variance obtained from the arch estimation of the error term of equation 5 as weights. Now here we have estimated these 5 models. The first model is demand side Phillips curve type model, or the ordinary Phillips curve type model, where we consider output as the only predictor. The second model and the third model are the supply side Phillips curve type model, where we consider crude oil prices and commodity future prices respectively. The fourth model is called the augmented Phillips curve type model, where we consider crude oil price along with output. And the fifth model is where we consider the commodity future prices along with output. So the fifth model is our proposed model. These models are with symmetric price changes. We also estimate the models with asymmetric price changes. So to calculate the asymmetric price changes, we decompose the price series into positive partial sum series and negative partial sum series following the methodology by SIM 2014 in there's NARDL paper. So then we use this price series in our estimation. The first model here is considering asymmetric price changes, asymmetric crude oil price changes. The second one is considering asymmetric commodity future price changes. The third one is considering output along with asymmetric crude oil price changes. The fourth one is considering output along with asymmetric commodity future price changes. Now, as the dependent variable, we are using the headline inflation as our dependent variable. And then we have chosen three forecast horizons of 3 months, 12 months, and 24 months in line with RBI's usual practice. And our in-sample forecast period is, or the estimation sample or the in-sample forecast period is from June 2006 to June 2017. And for the three sample out of sample forecast period, we have chosen July 2017 to September 2017, July 2017 to June 2018, and July 2017 to June 2019. We have obtained the CPI and the IIP data from the database of IFS database of IMF. Then we have obtained the commodity futures price index data from the database of the multi-commodity exchange, which is the largest commodity exchange in India. And we have obtained the crude oil price data from the database of Federal Reserve Centralist. This table shows the serial correlation statistics and heteroscedasticity statistics for our predictor variables. So as you can see that all the predictor variables suffers from the problem of autocorrelation as well as heteroscedasticity. Next, we test for the presence of endogeneity and presence of persistence. So as you can see, all the persistent test statistics are significant. However, we do not find here any problem of endogeneity, but this is the case when we use the inflation as the dependent variable, but instead if we use CPI as the dependent variable, then we find a significant presence of endogeneity. Now, when there is problem of autocorrelation, persistence, heteroscedasticity, and endogeneity, then the choice of FQGLS type technique is said to be appropriate. Now, this is the predictability test result. Here I am showing the results of only models with asymmetric price changes with and without structural breaks. So as you can see, for the model 5, that is our proposed model, all the coefficients are statistically significant. Even in case of other models, all the coefficients are found to be statistically significant. So we can use this model for the purpose of forecasting. Now, to evaluate the forecasting performance of different estimated models, we have used this 4 tests. We have used this Mincer-Jarnowitz test to check the unbiasedness of forecast. Then we have used this Campbell-Thompson test, Diable-Marino test, and Clark and West test for the purpose of forecasting evaluation. So this is the result for the Mincer-Jarnowitz test considering models with asymmetric price changes and structural breaks. So as you can see, all the chi-square statistics are insignificant, or all the p-values are are higher than their usual significance level. This implies that all the models are unbiased in nature. So there is no reason to prefer one model over another, at least in terms of unbiasedness. Now, coming to the main result of our paper. So here we have shown the CT's test statistics, that is Campbell-Thompson test statistics results for asymmetric, model with asymmetric price changes and structural breaks. So the models in the column headers are the unrestricted models, and models shown in the row headers are the restricted models. So if any CT statistic is positive, then the unrestricted model performs better than the restricted model in predicting inflation. So as you can see, for the model 5, that is our proposed model, all the CT statistics are positive. That means this model 5 outperforms all other models, all other restricted models in predicting Indian inflation. So this is the case. This is the in-sample case. This is, the case is same when we go for out-of-sample forecast with 3 months horizon and even for 12 months horizon. But in case of medium-term focus, that is when H is equal to 24, then we find that augmented Phillips curve type model considering output and crude oil prices can produce a better inflation forecast than the augmented Phillips curve type model with output and commodity future prices. Then we compare the models considering symmetric price changes and models considering asymmetric price changes. So as you can see, the models considering asymmetric price changes can produce better inflation forecast in comparison with models with symmetric price changes. This is in case of in sample forecast for out of sample forecast with is equal to 3, out of sample forecast with H is equal to 12, that is 12-month horizon, and for 24-month horizon. So the usual conclusion is that when we are modeling inflation in India, it is very important to consider asymmetric price changes rather than symmetric price changes. Now to summarize what here we have done, we have attempted to find out the relationship between commodity future prices and inflation in India, and using the commodity future prices and output, we have attempted to forecast Indian inflation. Now in literature, we have either found that papers, studies have done or estimated augmented Phillips curve type model either with crude oil prices or with commodity future prices, but in the same paper they haven't compared the result of the two models. But in this paper we have estimated both the models, and we have shown that commodity future price based augmented Phillips curve type model can produce Indian inflation better than the oil price based augmented Phillips curve type model. Now here we have used the FQGLS technique to deal with the problem of persistence, endogeneity, and heteroscedasticity. And we have found that commodity future price based augmented Phillips curve type model can produce better inflation forecast than the crude oil price based augmented Phillips curve model, at least in the very short run and short run. So these results have important policy implications for RBI, especially when they are practicing flexible inflation targeting. Thank you.
Okay, thank you, Rudra. So within time presentation and very interesting presentation of using the future prices. Now on the question board, as you can see, I can see a question from Professor Goel saying that basically, how do you link your breaks with the regime changes? And then the inflation targeting is supposed to lower pass through the commodity shocks. How would you assess that in your estimations?
Okay, in our estimation, I haven't considered that. So probably we should have considered a dummy variable for the non-IT regime and IT regime. So we can do that. That's a very good suggestion. Thank you, ma'am.
So while we wait for some more questions to come, I just had one small question to you. So you are forecasting this, and everything is going on a dynamic scale. So the previous paper, as you saw, is saying that interest rates are already changing when there is a changing commodity prices. How do you impact that? How much of this result is due to the changes in interest rate or the policy rate that RBI has already incorporated, and the residual is from the future prices?
Okay, then actually we haven't checked that. For that, probably we should have considered any policy rate as the predictor variable in our estimation. That can be done, but here the main objective of the paper was to check the forecasting ability of commodity future prices vis-a-vis that of crude oil prices. So that's why we haven't considered interest rate or any policy variable in our estimation, but that can be done.
Okay, so Ashima madam has another question saying that how efficient are Indian future markets, and are future prices good predictor?
Okay, so I haven't tested for that. I mean, we can test for that as well. But at least in comparison to crude oil prices, our commodity future price based model can produce better inflation forecast.
Okay, so Bhanu Pratap has a query on how are you estimating the output gaps, and he is suggesting that you can be perhaps a bit more talk a bit more about comparing the forecast performance of one model vis-a-vis other models.
Okay, so here we are considering output. We have considered IIP as a proxy for output. And here the performance of different models have been shown in terms of three statistics, test statistics. I've shown the results of only one test statistic, that is the Campbell-Thompson test statistics. I haven't shown the results for the other two test statistics that we have used. The test statistics are there in my paper. So if you go through that, you will probably find
Sorry, I
all the
didn't
test
get this
statistics.
point because he's asking about output gap, I suppose. So which methodology, like say bandpass or HP, which one you are
Oh, no,
using for?
sorry. I missed that part. Sorry. Yes, we have used this HP filter, and then we have reduced this HP filter based thing from the original output series to get the output gap.
Okay, so Bhavik has a question pointing out the problem of future prices. So how are you going to kind of decipher the effect of due to speculation? So he is drawing the attention of the shortcoming of the future prices. So what is your comment on that?
Sorry, I didn't get that.
So basically, he's questioning the future prices because there is a big speculation component in it, you know.
Right.
So he's saying that there could be some bias coming from that.
Okay. In the methodology that we have used, there is no way to control for that. But the informational effect that we were talking, that I was talking about, is due to that speculation, from the market participants. So if you just
So basically, it's a long question, but
right.
the points are very small points. What he is saying that future contract prices has to be interpreted carefully because there could be speculation effect. But I think speculation effect is fine in this particular
Right.
aspect. And he is saying that there could be jump because future contract has to be closed on a particular day, and therefore basically there may be a lot of volatility on those days. But I think arbitrage, speculation, and hedging, all the three are the things that makes future prices kind of so useful. But you can comment what you have thought about this.
Right. Actually, I have tried to use that information, and since we are considering monthly averages, then that effect can be ignored. I think. I don't know. I might be wrong, but I think that effect can be ignored. The jumps that he was talking about.
Okay, so the next question is from Professor Pooja Padi. Now, the question is about the fact that why only oil commodity futures and not the other commodity futures?
No,
Yeah,
sorry.
metal,
Actually, probably I should have more clear on that. I haven't used the crude oil futures prices. I have used the crude oil prices, that is the international crude oil prices, and for for the model that we have proposed, we have used the commodity future price index. So that considers all the future prices of all the commodities traded in multi-commodity exchange.
Sorry, if you please come again, you're not using the crude future prices.
For the model where we are using crude oil prices. So this is the international crude oil prices. There's Brent crude oil prices, WTI crude oil prices, etc. And the model in which I have used commodity future prices, that is commodity future price index. So that is an average of all the commodities traded in multi-commodity exchange.
Okay, okay, fine. Now, Bhanu's question, next question is that it's not very clear that how you are choosing the model. He's saying that he might have a benchmark model, which is a naive model, and then compare with your result with other models that are available. So basically, he has also given a link for the time series cross validation of the model. So have you done anything in this regard, or you have any comments on the same?
Actually, okay, definitely I will go through that paper. But the benchmark model is firstly we compared the performance of all models with the regular AR model. Then we consider the traditional Phillips curve type model as the benchmark model, and then we compare the performance of all other models with that of the Phillips curve type model. Then we change the model specification, we change the benchmark model. Then we consider the supply side Phillips curve type model considering crude oil prices, and then we compare the results of other models with that model. Then we consider the supply side model considering commodity future prices as the benchmark model or the restricted model, and again we do the same exercise and so on. So this is how we we have done this exercise.
Okay, so I think there are many useful comments that we have got here, and since we have a couple of minutes, so there is a question from Rajeshwari, and so okay, a long question. So I would request Professor Shingupta if you can go through this question since you are co-host already.
Yes, yes. So if I understand correctly, Rudra, what you're doing is you're comparing commodity futures prices to forecast inflation, and then you're looking at oil, just the Brent crude prices, right? So I was just wondering, wouldn't it be interesting to also use the oil futures prices to try and forecast inflation, and then see sort of like a comparative analysis to see which gives a quote unquote better forecast, especially given that oil, as we all know, is a very critical component of Indian inflation. So wouldn't that be an interesting exercise?
Right, ma'am. Actually, that is my next paper where we have considered individual commodity future prices. In this paper, we have considered the overall commodity future price index. So that is why we haven't considered the individual commodity future prices. But in our next paper, we have considered individual commodity future prices, and then we compare their forecasting performance with the benchmark models, considering crude oil prices, considering overall commodity future price index, etc.
Okay, that's great. But it's an excellent paper, because I think it's a very novel and good idea for India to
Thank you,
use
ma'am.
futures prices for forecasting inflation. We haven't seen this work before. So thanks.
Yeah, so thank you very much. If there are no other questions, then maybe I can summarize this entire session as a very useful policy relevant session. We started from commodity prices, and then the oil prices also, and then we saw the Taylor rule, Phillips curve, and the communication effects on stock market. And I'm sure that all the presenters have benefited substantially from whatever comments that they have got, and their papers will also benefit. I thank you, all the participants, all the presenters, and those who have kindly offered comments and references to the presenters. Thank you indeed. So over to Rashmi. If you have something to add, it's fine. Otherwise,
Sure. Yeah.
yeah. Thank you.
Thank you so much, Saurabh, for being such an excellent chair, and keeping time in a really, really nice way. I think I want to thank all the presenters for that as well. We are doing really good on time. Before we break for the short break that we have, I just would request everybody to switch on their videos, please, so that we can take a quick snapshot, because that's the best way we can sort of remember virtual conferences these days. So please put on a smiling face, and I'll let you know once our tech team is done taking the picture. So let me know when you guys are done. Okay, so we are done with the picture. So thank you so much, and I would like to remind everybody that we have a half an hour break now, and then we reconvene at 6:30 p.m. for yet another much-awaited keynote talk by Professor Arvind Subramanian. And we have had excellent audience participation over the last couple of days, and we look forward to nothing less going forward for the rest of the evening. And then, of course, at the very end, we have a very, very special session where we would be, it's in honor of Dr. Subir Gokarn, and I would request everybody and more to join for that session as well. So see you guys at 6:30 p.m. for the keynote talk. Thank you so much.
Hello, good morning, Dr. Subramanian.
Good
Hello,
morning.
sir.
Can you hear me?
Yeah, I can hear.
Okay, good. Excellent.
Yeah.
So we'll just start in about 1 more minute.
Yeah.
Yeah, sure. Hi, Raj, how are you?
Hi, good, Arvind. So looking forward to your talk.
No. Is it also being live streamed on YouTube or something?
It is being live streamed on YouTube, and then your slideshow will also be posted on the conference website once the conference is over.
Okay.
So Professor Mahendradev, the talk is for 40 minutes, and after that, audience will keep typing questions in the chat window, and then there'll be about a 20-minute Q&A.
Yeah.
And if needed, we can even go a little bit over because we have about half an hour break after that.
Yeah, sure.
Okay, so let's get started. I would like to welcome everybody back from the break for yet another much awaited keynote talk by Professor Arvind Subramanian, which will be chaired by the IGIDEA Director and Vice Chancellor, Professor Mahendradev. Professor Mahendradev, over to you now. Thank you.
So good evening and welcome to the keynote address by Professor Arvind Subramanian. I'm happy to introduce him. As you know, Professor Arvind Subramanian is a renowned economist. He was the Chief Economic Advisor to the Government of India between 2014 and 2018. He is now Senior Fellow, Brown University's Watson Institute for International and Public Affairs. Previously, he taught at the Harvard Kennedy School and was the Dennis Weatherstone Senior Fellow at the Peterson Institute for International Economics. In fact, the Foreign Policy magazine named him as one of the world's top 100 global thinkers in 2011. You all know his contributions as Chief Economic Advisor to Government of India. He oversaw the publication of the Annual Economic Survey of India, which became a widely read document on Indian economic policy and development. For example, the 2018 survey had 20 million views from over 190 countries in its first year of publication. His contributions to the Indian policy making are well known. Among the major ideas and policies he initiated and helped implement were a simplified GST, attempts to tackle the twin balance sheet challenge, and creating the financial and digital platform for connectivity, that is the so-called JOM Trinity, charting a new fiscal framework and a universal basic income. Announcing his departure as CEA, the former finance minister, Mr. Arun Jaitley, wrote a Facebook post. Thank you, Arvind. So his award-winning book, Eclipse, Living in the Shadow of China's Economic Dominance, was published in September 2011 and had printed 130,000 copies worldwide in 4 languages. His latest best-selling book, reflecting on his time in India, of Counsel, The Challenges of the Modi-Jaitley Economy, was published in Penguin Random House in December 2018. The title of his keynote address is Peering Back to Look Ahead, Measurement and Prognosis for the Indian Economy. Yeah, he's been working on this, the measurement and all, last several years, few years. I was told he's also going to present some of his new research on this topic. So he will take about 40 minutes. We'll have Q&A for 20 minutes. So as Rajeshwari mentioned, you can write your questions during the talk or after the talk in the chat box. So now I request Professor Subramanian to give his address. Thank you very much.
Thank you very much, Professor Mahendradev and IGIDR for inviting me. I'm really honored to be here to deliver this address. There are, so many terrific scholars at IGIDR who have worked on some of the issues that I'm going to talk about today. So I'm kind of doubly honored and also a little bit scared of presenting all this in front of people who know this probably much better than I do. It's also a particular honor to take part in this year's event because, as you know, we're celebrating the life and work of Subir Gokarn, who was such a great human being and such a terrific economist and policymaker. So I'm kind of doubly honored to be here. Today, what we want to present is some new research that Josh Feldman and I have done, peering back to look forward from measurement to prognosis. And without much ado, let me jump right into it. And I, of course, look forward very much to your comments and questions. And Josh and I would be delighted to respond to them, at the end. So just by way of setting the context, the big issues of the day today are, is India back? And of course, the related question of, what is the likely potential growth? In fact, in today's Times of India, Poonam Gupta who's the Director General of NCAER and a terrific economist, has a piece on this. What is India's likely potential growth? And I think it's fair to say that there is a lot of optimism. I think there's one view which says that there are going to be few scars from the pandemic. The twin balance sheet challenge apparently is getting better. And so many believe that growth will go back to normal. Now, of course, but that begs the question, what is normal? And that's what I think, to get a sense of what is normal going forward, we need to have a sense of what was normal in India's recent history. And that's what Josh and I want to present today. So just to, again, I don't want to bore you with a lot of economic history, but I think in the pre-COVID period, one can identify, I think, three phases, as it were. The early 2000s to the global financial crisis, where, the world boomed, and of course, India boomed in particular at that time. Then the period after the global financial crisis to 2018-19. And then there was a 2019-20 slowdown, which I think raised people's, concerns about where the economy was heading. And so I want to just show you some numbers on these three distinct periods. So let's start with, the first period, the acceleration. So this is a chart, and I just want to spend 2 minutes on this chart because it's important. This will be the kind of charts that we're going to be presenting again and again. So let me just say that on this chart, we're showing the acceleration. So what we've done here is we've chosen the key macro indicators, and we're showing everything in sort of real terms, annual average. There are two periods. The blue is 96 to 2002, so kind of the pre-boom period, and 2003-10. I mean, you can change it by a year there. It doesn't matter. It kind of captures the peak of the boom. And the indicators that we show are, I want to be careful and specific here. They're basically macro indicators that capture either are or proxy for indicators of demand, exports, imports, investment, or they are indicators of macro supply side things like, what is the profitability of the corporate sector? So we show profits upon GDP. And of course, a third indicator that we show is, the financing of the overall economy, and that's the credit thing. Everything is in real terms, as I said, all annual average. So they are macro indicators that should capture the economy as a whole in various dimensions. And also we have confidence that all these indicators are actually, well measured, whether it's the IIP, or whether it's taxes, whether it's trade, whether it's credit, which comes out from the RBI, or profits, which comes from the CMI. And what you see, I don't want to go through every number here, but what you broadly see is you see the boom, you see, the annual average rate of growth, no matter what indicator you take, goes just surges in the boom period. Just to give an example, IIP investment, it was 6.5% per year in 96-2002. It shoots up to nearly 20% per year in the boom period. Similarly with credit, 9.3% in real terms credit growth pre-boom and 16% during the boom. So this is the surge in macro indicators capturing the boom. And then, of course, for the period after the global financial crisis, we showed 2003-10 to 2013-18. And you see that in every indicator, macro indicator, there's a complete bust. IIP investment goes from 20% per year, which I just showed you, to less than 4% every year. Credit grows from 16% in real terms every year to less than 5%. Exports collapse from about 15% to 4%. Tax revenues collapse and so on. So you see both the boom and the bust in all these major macro indicators on the demand side, on the supply side, and on the financing side. And then we now have new data. We have new data from the recent debt and asset survey. It's for 3 time periods. And what you see is that you see the same pattern of boom and bust. The time periods are slightly different because that's when they're measured. But whether it's asset growth or urban asset growth or rural asset growth, in real terms, you see the boom and you see the bust over broadly the same period. So we have new data that confirms this pattern as well. So the story so far is India has gone through a pronounced boom and bust, boom from the early 2000s to the global financial crisis, kind of bust from GFC to just before the pandemic. It created these balance sheet problems, which Josh and I called the twin balance sheet challenge way back in 2014. So then we get to this, what we would call the Solow puzzle. Robert Solow famously said, if you remember about TFP, you can see the computer age everywhere, but in the productivity statistics, because he said, you don't see the growth of the computer age. So the parallel question we ask is, can you see the boom bust in the national income account statistics? And it turns out that, it's a bit mixed. It depends on which statistics you use. So the question is, where's the boom? Now, I want to hear just, again, by way of reminding all of you, you know this better than I do, there was the old series with the 2004-5 base. There's the new series with the 2011-12 base. Then there was the old series using the 2004-5 base. Then the National Statistical Commission submitted its report. Sudipto Mandal and Bhanu wrote this about the GDP. It's submitted in 2018. And of course, then the new series, if you remember, in late 2018, 2019, or after I had left government, the new series was backcast for the 2004-2011-12 period. Now, this is not the forum to get into all the methodological issues. And in any case, it's been done by so many excellent scholars at IGIDR itself. Professor Mahendra Dey, Professor Nagraj, Rajeshwari, many others, Professor Goldar, Bhanumurthy, the late T.N. Srinivasan, Sebastian Morris, Pandya, all of you have worked on this. And so I'm not going to address the methodological issues, but just to kind of show you the implications of what the numbers are showing us, telling us. And that's what I want to focus on today. So the old series, showed growth going in the same 2 time periods for which I showed you the macro indicators. It did show a reasonable surge, a reasonable acceleration, 5.5 to about 8.5. That's kind of reasonable. And in fact, the National Statistical Commission, actually, when it submitted its report, it said that the numbers from the old base, if anything, understated the boom, and so they actually hiked up the estimates for the 2004-5, 11-12 period by about 0.5 percentage point. So they said, in fact, the old statistic, and this was done very carefully. And of course, as we know, this report never saw, or at least the recommendations were not accepted. So the old series and the NSE series showed a boom. If you look at this, 5.6 to 8.6, that's a real boom. But what happened, of course, when the series was back, when the 2011-12 series was backcast, there was a serious downward revision of historical data. One often thinks of countries want to show that they're doing better than they actually are. So typically, GDP estimates tend to be on the high side, but here maybe one of the unique cases in history where official statistics said no, actually growth was lower. Of course, it was lower in the past, but it was lower, and there were some really serious downward revisions to the backcast series. And you see that, for example, in 2010-11, almost a 2 percentage point reduction. Similarly, in 2007-8. So there was we call this the Great Revision. And then essentially what happens is that in the new series, that acceleration is kind of taken away, and we get more like a steady increase in growth rather than the acceleration. So the sizzle, the boom, kind of is kind of taken away by the new series that's measured. And in some ways, and I feel a bit guilty about this, that a lot of the GDP debate focused on the period after the revision 2011-12, but we've kind of forgotten that there was also a major revision of the historical 2004-5, and this is kind of one consequence where the macro indicators show a boom, and the new series shows that there was a steady increase, but certainly no boom. Then, of course, we say, where's the bust? Just let me remind you, this thing really collapsed. As you can see, all the macro indicators, but in the official numbers, there's no, it's kind of growth continues on, between 2010, 2013, 18. This was, of course, the subject of a lot of the work that all of you have done, many of you have done, and the work that I presented also in 2019. Just to remind you, collapse, annual average rate of growth, all these indicators drops in some case by 10 percentage points per year in real terms, all these major indicators. And of course, we see, the official story is that growth continues at a steady, cheery pace. Now, what happened in 2019-20? I want to just show you something because this is really stark. The official growth numbers you should see on the left-hand side, showed a fairly sharp decline in growth. So I think the 2019-20 number on the left-hand side is what first started raising people's real concern about where the economy was headed. And that decline somehow also comforted people or reassured people that actually, measurement was fine, because see, the official numbers are showing a decline, and we see that in the economy. But what I want to show you with the right-hand side chart is that 2019-20 GDP number of 4% is highly misleading, because the economy basically collapsed. It didn't decelerate in 2019-20, it collapsed. Look at all the macro indicators, other macro well-measured indicators, they're all in a negative or deeply negative territory. Real credit declined by 1.5%, exports collapsed, the IIP consumption collapsed, tax revenues, imports, everything was in negative territory. So in 2019-20, there was no deceleration, but a collapse. So in a sense, this partially answers the question of when COVID hit, why was the hit in 2020 so bad? The partial answer that Josh and I have is that it came and affected an economy that had already experienced a very serious decline and a collapse. So to put it somewhat sharply, there was a pre-COVID collapse even before the COVID collapse of 2020. This chart on the right-hand side, this 2019-20 number on GDP is kind of really, I don't know how to say it euphemistically, I think it was very, very misleading, but it had just enough of a flavor of decline for all of us to think, yes, it's well measured because it's showing a decline, but actually it was actually highly misleading because it failed to capture the complete collapse of the economy pre-COVID. Remember, this was the post-ILFS period. This is the period about which Josh and I wrote a piece in 2019, a paper saying that the economy was in the intensive care unit in December of 2019, and it turned out that it really was in the ICU. Now, just to summarize the growth puzzle, indicators, all the macro indicators suggest boom, bust, or boom, sharp decline, and collapse. But in the GDP numbers, what you see is a kind of high and steady-ish growth with some decline in 2019-20. So it's actually a completely different story that you see from the macro indicators. Now, the new part of the research that I'm going to show you now is, and it's something that's not been, at least I've not seen remarked enough, which I'd like to alert you to, is what I would call, we would call the consumption puzzle. So if you think whatever happens to GDP production, measured, overestimated, underestimated, there must be some consequence on the expenditure side because of the identity y equals c plus I plus g plus x minus m. India measures y from the production side, and it measures various components on the demand components on the right hand side. I think we have reasonably solid data for I, investment, government, exports, and imports, but consumption has been traditionally difficult to measure. It tends to be a residual. But the identity actually gives us new clues about the GDP measurement itself, and that's what I want to talk to you about today. Is there evidence that C is consumption is mismeasured? So just to give you, let's take two kind of iconic items of consumption. The upper middle class and the upper class, they buy cars, and the lower middle class and the lower class, let's say economic class, they buy passenger two-wheelers. So I'm just abstracting just to give this as an illustrative example. I'm going to show you more macro numbers, and you see the same pattern of acceleration and decline. And of course, in 2019-20, you also see the collapse in these consumption indicators, which I'm not going to show you. But I want to show you that passenger sales pre-boom 10% per year, boomed almost 20% per year. 2013-18 post-global financial crisis collapsed to 2%. Similarly, two-wheeler sales, it's less marked, but it's still very sharply there, 10% to 13% to 18% to 8%. So you see the boom and the bust in the private consumption numbers. Now, what about in the macro aggregate consumption data? So here I'm showing for the same time periods the old series, the IIP for consumption, which is a proxy, a macro proxy for consumption. And I stress it's a proxy, it's not the actual thing. I think, of course, there are other things going on. And then there's the NSS data. Now, I don't want to get into each of the individual numbers and the levels, because I think we can endlessly debate them, as we should. But what I want to show you is that exact pattern of acceleration and deceleration. You see it in the iconic car data, two-wheeler sales data, but you also see it in the macro, other macro consumption series data, whether it's the old series whether it's the IIP for consumption or whether it's the NSS, you see this sharp increase and the sharp decline in aggregate consumption. Now, so this is, I think, maybe a small insight that I want to share with you, that when the GDP got revised, consumption had to be revised on the expenditure side, because everything else really can't be, they are hard, reliable data. So in a sense, consumption bore the brunt of the revisions in GDP. And what you see is, big revisions in consumption, much bigger in percentage point terms than the revision in the GDP, because it's simple. If you change Y by 1 absolute rupee, you change C by 1 absolute rupee, but the percentage change in C is going to be much greater because C is less than Y. And what you see is, for example, look at 2006-07, the consumption was revised down by 3.5 percentage points in 1 year. Similarly, 2007-08, almost 2 percentage points, 2010-11. So the revisions in GDP necessitated and forced a major revision in consumption, and which revisions also kind of jar relative to the acceleration deceleration story that all the other indicators of the economy are saying. So, and this is kind of the stunning thing I want to show you, that now if you look at the official data, it says not only did private consumption not decelerate, it accelerated in the post-global financial consumption period. So two things I want to emphasize here, or takeaways from this, is the consumption story that you get is one of a boom, continuing boom, and accelerating consumption, whereas the macro indicators show boom and bust, acceleration and deceleration. And the second insight is that this pattern in consumption is because of and derives from the changes in GDP. So if you change GDP, this will necessarily happen, and it will give you something that's completely at variance with our understanding of what the economy did. For example, if you just compare this with the car sales, it's exactly the opposite story. Not steady growth and acceleration, not boom and sharp decline, but steady growth and acceleration. So in some ways, the consumption, if you think of this as kind of forensic economics, the clues are as much in consumption as they are in GDP, or put it differently, the consumption numbers give you a clue about the reliability of the GDP statistics. So just to kind of say here, the official data, and remember this is all the macro indicators that I've been telling you are all official data. So this is not a kind of criticism of all official data. It's just that some official data that we think are independently and reliably measured, they tell a very different story from the national income accounts data. And just to summarize, the macro indicators show a boom bust collapse, but the national income data show steady GDP growth, no boom, decline and collapse, and accelerating consumption, not a collapse in consumption. And I want to remind you that that mismeasurement problem was particularly serious in 2019-20, when every indicator was showing, major indicator was almost showing negative to very negative growth, and the aggregate GDP number, while showing a decline, still showed a very decent growth of 4%. So this is kind of the measurement part. So we look for what is normal. Now, so just to give you a fact, I think this is the official growth story, a high and steady from about 2003 onwards. And then I want to, there is an alternative growth story where the red dotted line says, actually the boom was much boomier, as it were, and post-global financial crisis was very different from what the official indicators suggest. And I want to just be cautious here, is that for the pre-2011 numbers, we actually have alternative semi-official data done by Indian scholars themselves and Indian officials, which is the old series and the National Statistical Commission. And this is just reproducing their numbers from before 2011-12. And after 2011-12, as we've argued and as I've tried to show now, it's a very different story that the macro indicators tell. Obviously, no one has actually measured the new numbers based on this, but it seems like it was, much below the official numbers. And I want to emphasize that there's kind of uncertainty. It's not a hard and fast number that I'm saying this is the thing, but we know based on all that I've shown you now, the macro indicators, the consumption indicators, that our intuition about the acceleration and the deceleration and the collapse just don't show up in the official numbers. And a much more plausible story is this story in the red dotted line. Now, so what are the what is the kind of normal growth going forward? So looking back, if you say, and that's kind of what Poonam Gupta was arguing today, you see, when as economists, we know the dirty secret that when people calculate potential growth going forward, it's essentially some very pseudo-sophisticated, backward-looking weighted average growth rate. Whether you take Hodrick-Prescott filters, et cetera, it's basically a sophisticated, historically weighted average growth rate. And so if you kind of buy this story about all the indicators are saying that the actual growth story was something like the red dotted line, then the pre-COVID growth was closer to 4% than the official number of 7%. And so if you think going forward, that's the normal growth, then you get a very different estimate of the potential. Now, that's just based on just mechanically looking back and extrapolating that forward. Then, of course, you have the COVID shock. And, I'm happy to answer questions, take questions in the Q&A. There's a lot of now new literature on this, which says that potential growth has been affected by COVID in at least 3 significant ways. There's the human capital story because, for 2 years and still children are out of school. The labor market has been, Mahesh Vyas has been showing that employment has been well below pre-pandemic levels. So there are kind of serious scars from COVID. Then, of course, there's the small and medium enterprise story, which, as we know, has borne the brunt of 3 shocks in the last 5 years. There was the demonetization shock, there was the GST shock, and the COVID shock again disproportionately affected the small and medium enterprises, because we know that COVID affected services more than manufacturing, affected retail, restaurants, small businesses much more. So there's a scar to the small and medium enterprises. And of course, there's a broader point which is being made all around the world that, that because the post-COVID world is going to be very different, there has to be a reallocation of resources. Just to give one example, commercial real estate, for example, in the US is now going to be significantly underused because people are not just going to have show up in offices like they did pre-COVID. And of course, you could think of various such examples, much more digital-based over contact-based activity, which will require a serious reallocation of resources. So all of these are likely to, affect potential growth. I mean, I don't want to completely just point to one side. Maybe there are also things about the post-COVID world that are going to give new opportunities. You know, we've seen the rise of unicorns and entrepreneurship in the digital and technology sectors, where there seems to be really a very exciting new activity going on. So maybe that's going to bump up potential growth, at least in some sectors, high-tech sectors to some extent. But broadly, if you buy this story that, you know, the pre-COVID potential was much below what the official numbers say, and then you have these major COVID shocks, then you're looking ahead at potential growth, which is kind of not close to the rosy estimates that are now being touted by everyone. Now, you know, this is not, you know, a story about data for data's sake. Of course, I mean, of course, we are, as academics and researchers, you know, we want to get this right, but it matters deeply because, you know, data drives diagnosis, a diagnosis drives policy. Then, of course, if data are mismeasured or unreliable or cannot be relied on, then both diagnosis and policies can be misguided. And just to give you an example of the diagnosis problem, we really have, if you follow the kind of commentary in India in the last 2-3 years, we have a story which Sajid Chinoy says, which basically says that consumption has sustained growth in the post-global financial period. And then there are others like Ratin Roy, Nainan, Harish Damodaran, who've been writing saying consumption has collapsed. Oh my God, consumption has collapsed. Where are the sources of growth going to come from? And really, you know, a part of this comes from, you know, what measure you're going to look at. If you're going to look at the official numbers, consumption has, far from having collapsed, as I showed you, has been accelerating. So the question is, what are you talking about? You know, but on the other hand, if you look at the you know, more realistic numbers, you do see that, you know, consumption has come down very sharply. And while it may have propped up growth to some extent because investment and exports collapsed, it's nowhere has the role that, you know, some people are making it out to be. So that's kind of a good example of the diagnosis problem. Then you have the policy problem, which really, you know, and I say this as someone who actually, while in government, saw this very, very, you know, I'm speaking from almost personal experience, because, you know, if you think that growth has been rapid and steady, then there is no reform urgency. And in fact, you know, I used to have this, I had this discussion with Mr. Arun Jaitley a few months before he sadly passed away, that, you know, had the data been, you know, shown the slowdown, the urgency to act would have been different. And also in the 14 to 18 period, there were all these discussions about, you know, fiscal and monetary policy, how supportive they should be. And of course, you know, if we thought growth was, you know, really steady and high, the case for supportive fiscal and monetary policy were correspondingly weakened. And I saw that too in action. So if growth has been rapid and steady, you know, you don't need terribly supportive policies. You don't need to act urgently on the other reform measures like the twin balance sheet challenge and so on. But on the other hand, if the pattern has been boom, decline, and collapse even before COVID, then the policy implications are very, very different, because then we need very serious remedial action, especially on the reform side. And so, you know, the looking back is not just kind of intellectual, technical exercise for its own sake. It matters deeply, deeply for, you know, how we think about, you know, supporting the economy or reform the economy, and the urgency with which we act going forward. So let me conclude. I'm sorry for having taken up so much of your time. Just to say that reliable data are absolutely essential for correct diagnosis and effective policy response. You know, we need a good and reliable story about recent Indian economic history that's consistent with all that we see around our intuitions, all the macro indicators, the consistency and so on. And the corollary, the policy corollary, we would say, is that without strong policy actions, in fact, what Josh and I say is that we need some fundamental improvements, not just in terms of tinkering with one policy or the other. We basically think that there needs to be fundamental improvements in the policy framework and the process of policy making, which we call the policy software. And just a couple of days ago, we have a new paper in Foreign Affairs magazine where we talk about this defective policy software, which includes things like rule of law, consistency of actions, data integrity as a key underpinning to that, not having arbitrary action, creating a climate of consistency and level playing field between investors so that private investment can come back. Because as we know, unless private investment and exports come back, we cannot have sustained growth in the economy going forward. So the policy, what we call the policy software, which is not just one policy here or there, but the whole framework and the process needs significant improvement if India is to get back to the kinds of growth rates that we saw prior to the global financial crisis, and that definitely has eluded us post-global financial crisis by a significant amount, which unfortunately the data are not, some of the official data don't seem to show. So let me stop there. Thank you all for listening. Sorry if I bored you, and we'll be happy to take questions.
Thank you, Professor Subramanian, for excellent analysis on measurement and prognosis up to 29-20. A lot of food for thought. This consumption puzzle and 2019-20, your analysis is very interesting. First, question is on consumption expenditure. As you mentioned, Sajid Chinay said, consumption sustained growth when investment rate declined, particularly up to 2016-17 or 2018. After that, of course, as you mentioned, NBFC ILFS scam happened and has reduced the liquidity, and also consumption growth also declined. So that is the growth in GDP declined from 2017-18, 8% to 6.8, and then 4%. If you believe the official figures. But on consumption, this national account statistics and national sample survey, in any country, you have differences between the two. But in India, in the 70s, it was 10% difference. But the latest leaked data showed that 70% difference between NSS and national accounts statistics on consumer expenditure. So there is something wrong. Either NSS is wrong or the NAS is wrong. Of course, as you mentioned, it's NAS, it's a residual. But household data also, nowadays there are problems. We have investigators problems and other things. So what's your opinion on consumption, puzzle?
Yeah. So Professor Mandev, a great question. And that's why I would be at pains to emphasize that I don't want to compare the levels of one or the other, because that's just a huge debate that's gone on. What I want to emphasize is the pattern that you saw between all the other indicators of up and down, whether it's the old series, whether it's the NSS, whether it's the IIP of consumption, that pattern, you see almost the opposite pattern, the time pattern in the official data. I don't want to get into, which is, how much is the wedge between NSS and national income accounts, because that's a completely different and, a whole field of inquiry, which, I'm not the expert on. But all I want to say is that the time pattern are so different, and it seems like all the other indicators, whether it's NSS, car sales, or the old series, the IIP, they seem to be giving us a time pattern that's more consistent with what we know about the economy than the national income accounts. So that's what I want to emphasize more, the pattern over time and how implausible that pattern is for the national income accounts, without wanting to now at this stage get into any debate about the individual numbers for individual periods.
Thank you. My second question, last one, is on medium-term growth. You're saying normal is around 4% in the last few years per annum. This can reduce further in the post-COVID period. Already 2019-20 and showed. But you're also saying that it could be 7% if software problems are resolved. So, but do you think they can be resolved? For example, the export protection, the tariff protection and those kind of issues.
Yeah. So again, a great question from Andev. I think that certainly one of the things that we talk about in this foreign affairs article, and it's also some work that I did with Soumitra Chatterjee on India's exports. Let me just spend 1 minute because it's a very important question. The current strategy for exports seems to have three components, right? One is a reversal of import tariff protection because tariffs have gone up. And Soumitra and I showed that about 70% of imports, there was about a 5 percentage point increase in the average tariff, and it affected about 70% of India's. So the first prong is of this kind of Atmanirbharta is raising protection. Two is much more kind of industrial policy, which is giving subsidies to selected sectors. And three, the third component is actually staying out of international integration agreements, especially in the dynamic region of Asia. So the question is, can this three-pronged strategy actually boost exports or not, which was your question. And our feeling is that, it's almost as if these three prongs are highly unlikely to generate this. And let me give examples of each of these. So clearly tariffs have gone up, and I don't mean to suggest by any means that they've gone up to the levels that we saw, in the pre-reform period. They were much higher then, much more arbitrary, much more quantitative restrictions. So it's not the same regime, but it is a reversal of a 30-year consensus of steady decline in protection. That's been reversed. Now, what does that do? If you raise tariffs, we know from the theory that input costs go up. If you take, for example, clothing, which is a highly input intensive sector, then if you raise tariffs, then your cost of production is going to go up, and your exports are going to suffer. But the deeper problem, of course, we know is that an import tariff is an export tariff. That's the Abba-Lerner symmetry theorem. An import tax is an export tax. And so that, protection is especially going to be difficult. Now, when you combine that with the third aspect, i.e. staying out of international agreements, the two play off each other. So just to give you one example, suppose investors are fleeing China because China is becoming uncompetitive, wages are rising, or that China is becoming very arbitrary. That investment will want to locate itself in a place where it says, we can use that as a launching pad for exports. Now, coming to India, India maybe is a biggish market, but those investors don't want to come to India just for the Indian market, because actually the Indian market is actually much smaller than people think it is. They want to come for the export market. But if you're not part of international supply chains, your costs of inputs are going to be very high. If you're going to want to export to the most dynamic regions in Asia, well, you're left out of those free trade agreements, so your access is going to be much worse. So that's why this strategy. And then the third strategy of the PLI, the production linked incentives, I think Shankar Acharya wrote a very nice piece on this about a year ago. I think the one thing I would add to that is, these PLIs are effectively, most of the beneficiaries are kind of tech-intensive and capital-intensive sectors. And if we want inclusive growth in India, we need labor-intensive, unskilled labor-intensive growth, which, the PLIs, they're giving some, but that's not the focus and the thrust. Our clothing, footwear, consumer products, those are the ones that need. And there you need cheap inputs, you need access to markets, and you need, easy, the cost of doing business, the cost of trading have to be very easy. So that's the sense in which it's not, we think it unlikely that this strategy will deliver, very rapid export growth.
Thank you. So we have in chat box some questions. Dr. Abhay Pete, I'll pick up some. Dr. Abhay Pete said, in this in charting a reformative dynamic path, the role of effective cooperative federalism is important. So in this current conflict-ridden polity. So care to comment on how do you improve the extent?
Professor Pete, I agree 100% with you, 100%. Now, I didn't mention, but if you read our piece and our earlier pieces, for us, one of the key components of the policy software is trust between the center and the states. So let me make a bigger point, and then I'll come to the excellent cooperative federalism point that Professor Pete made. You see, more broadly, we need trust between the government and private investors. We need trust between the government and citizens. And in a large country like India, and this is where Professor Pete's point is very important, we need trust between the central government and the state governments. Now, why is it important? I think it's just important in just so many ways. And let me give you two examples. Let me give you a kind of a positive example and then a kind of a less positive example. I mean, let's take our goods and services tax, right? I mean, for all its initial design flaws and implementation, we see today that, the GST, I have full confidence that going forward with all the changes that are being made and the fact that even revenues are coming back despite growth being a relatively, or rather revenue performance is exceeding a growth performance. So maybe some improvements are already happening in the way GST is being implemented. But in the long run, we know it's going to be effective, but it's going to be effective because of cooperative federalism, because of the way in which the states and the center came together, both to design and implement that. I mean, that's a thing. Now, so that's, I think, and that happened under this government. I think it's important to remember that this government did the GST, and under Arun Jaitley's stewardship, we got this really fantastic bout of cooperative federalism. But let's take other examples. You take agriculture, for example, right? I mean, lost in all the debate about agriculture is the fact that, no one denies that agricultural reform has to take place. Nobody denies that. But we know that in India, agriculture is, even though it's a state subject, it's regulated both by the states and by the center. The center gives fertilizer subsidies, MSP. The states do a lot of the procurement. They give the power subsidy. They do the irrigation, etc., etc. So any reform of agriculture will have to happen when the states and the center come together on a reform strategy. So I think agriculture, what happened, is a powerful reminder of Professor Pete's excellent point that unless you do cooperative federalism, you can't solve many, many issues in India. Let me give another example. The power sector is another example where, again, the center and the states both regulate this. And unless the center and the states come together, power reform in India is going to be, and I can carry on and on, but the nub that cooperative federalism is key. It's an integral part of the policy software that Josh and I have spoken about, is a point it's a fantastic point and a point that's very well taken.
Yeah, there is a question from Rajeshwari. So there has been no attempt to correct the measurement problem in the NAS, and that the GDP series and its components are being used to show that economic recovery now is strong. So to what extent, therefore, can we believe this narrative about strong recovery? What's your sense of the kind of recovery the Indian economy is experiencing now?
See, let me say, see, and really, I want to be a little bit careful. I think as an academic and serious researcher, we need to be careful here. I want to be careful here. Let me just say upfront that all that I've said here stops at 2019-20. I've not said anything about the measurement in the COVID period. And I haven't said anything for two reasons. One, I haven't studied it. To be honest, Josh and I have not, studied the measurement part of this. So I don't want people to say, what about now? To be honest, we haven't studied it carefully. And the second thing, of course, is that one generally has to be careful about, how measurement and the relationship, the economy itself undergoes a lot of structural change in this. And then the connection between measurement and the economy also could undergo rapid change in such extreme events. So one has to be very careful about that. But having said that, you take the IIP number, for example, that's been, that we know is kind of, it's kind of easier to measure. And for that matter, even the GDP measure, if you look at the level today, the GDP is barely back at the pre-pandemic level, and the IIP is still below the pre-pandemic level. So I think we are mistaking, or there's a risk that we mistake a natural bounce back from a big decline, which is happening, and which is very good. I hope more of it happens. But if you look at the levels of some of these indicators, I think they're still not back. So I think it's far too early to, if I were a policymaker, I'd be very cautious about celebrating the numbers, which are still, let's be honest, fairly weak. Compared to the pre-pandemic level. If you look at IIP consumption, IIP manufacturing, especially IIP consumption, it's well below pre-pandemic levels. So I think, but on the other hand, as I just said, tax revenues are doing well. I think maybe that's an harbinger, maybe that, things will improve going forward. But what I would say is that the recovery is still, a work in progress, and we need to see. Second, that we still don't know what it all means for the post-recovery period, that we still haven't entered into. And the aim of this presentation was to say that whenever we get, whenever we come out of the recovery and COVID and are back to some semblance of normal times, the kind of potential or normal growth there has to be seen in the context of what happened between 2013 to 2019-20 on a more, factual and realistic assessment of that period than perhaps what the official numbers might tend to suggest.
There is a question from Ashima Goyal. So as an insider at that time, what is your view on the reason for the sudden deterioration in just the national income data?
Sorry?
As an insider at that time, what is your view on the reason for the sudden deterioration in just the national income data?
Well, I've written that, the first, the revision of the series was, the 2011 thing was in part in large part a kind of technical issue, not a political issue. At least between 2011 and 12 and 2017-18, those numbers I think were much more a technical issue, and the way deflators were done, the extent to which the informal economy was measured. But thereafter, after 2018, I just cannot say, because I wasn't there. At that stage when we were there, we certainly spent a lot of time and effort trying to see whether, what components of the technical aspects could be improved. But remember, a lot of what I've been speaking today is also about the backcasting, is about, therefore, the implied changes for consumption, which happened, after 2018, and I wasn't there, so I don't know. I can't speak to that question.
Yeah, somebody said about the stock market. I mean, there is a disconnect between stock market and the real economy.
I think that three things to say about that. I guess again, I'm not the expert on the stock market. Firstly, we know that valuations all over the world have been elevated because of cheap money until very recent. Now, of course, the macro outlook in the US and the Federal Reserve policies are going to change going forward. But certainly until very recently, we've had a lot of liquidity around in the world. And there's no doubt that that has contributed to elevated asset prices, stock markets all around the world, including India. That's point number one. Point number two is that I think even allowing for that, the Indian stock market, at least when I presented a version of this at Brown University in October, early October, and at that stage, Josh and I, when we looked at it, the Indian stock market had outperformed other stock markets. And part of the reason for that, of course, is this whole, first, the kind of composition of the Indian stock market, we know, is weighted towards kind of big firms, commodity-based firms, and also technology-based firms. So to that extent, stock markets reflect the Indian economy less, because of the weightage of all these, very special and, very tech-intensive, capital-intensive, commodity-intensive sectors in the stock market. And therefore, some of those sectors have actually benefited from COVID. The whole rise of unicorns, the tech sectors have actually benefited from COVID. So that also reflects partly. So easy money globally, the nature of the Indian composition of the stock market, the nature of the COVID shock, all reflect. But it must be said that it would be a kind of policy mistake or an analytical mistake to infer anything about the broad-based and diverse Indian economy based on how the stock market does. And we've seen a lot of evidence on that in our employment after COVID. Mahesh Vyas has been documenting that in all the data that I showed about consumption. So I think we should keep all these in mind when we think about why the stock market is doing well and what its implications are for the economy.
Yeah, one question is on your twin balance sheet. So what do you think now? The NPAs have declined and the corporate has done well during COVID.
Yeah, so I think it's a very good question again. I think it's one of the if you think about it at one level, it's kind of bizarre that you get a massive COVID shock, and that actually improves the twin balance sheet challenge. At one level, it's a bit bizarre to even put that, so next time you have a balance sheet problem like this, we need a kind of massive COVID shock or GDP shock. But kind of lightness apart, I think a couple of things have happened. I think one is that there's precisely because the COVID shock was a disproportionate shock which benefited some big firms, the resource intensive firms, the tech firms, and so on. I think that helped profits. And so that certainly improved the financial position, at least of the big corporates, but at the expense of the labor market. So that's why, one has to be a little bit careful that, profits have indeed gone up, financial position of the big firms has indeed improved, but what it means going forward, I think is a bit of a question mark, is going to depend upon the overall state of the economy. That's point number one. Point number two is that obviously, of course, some of these big firms have also benefited from the stock market boom. So they've been kind of substituting equity for debt, and that has also improved their financial positions a lot. And I think we should keep that in mind. But I think, and then, of course, the last point I would say is that there is still the open question of the SMEs. They've been very badly hit. Of course, they are less, compositionally, they account maybe for less of debt than the bigger enterprises, but they still account for a fair amount of debt. How, their position, we need a little bit more clarity of that position going forward. And the last point I would say is that, we know that in the last 3-4 years, while overall credit has been, very weak, credit for consumption has been very high. So it's what we need to now monitor is, to some extent, the twin balance sheet problem maybe has come down, and we should look at that. But other balance sheets are getting stressed. SMEs, consumers. I think we need to be watchful about that as well. And also I think that we should also remember finally that the levels of NPAs, while they have come down, are still high. I mean, in the public sector banks, they're still in excess of 10%. And therefore, whether it's bankruptcy, whether it's bad bank, we shouldn't lose momentum on resolving that part, because directionally there's improvement, but the levels are still high.
Last question is, the inflation, will it affect the post-COVID growth?
Yeah, I think that, again, that's a great question. Remember now, this whole inflation thing is now, firstly, it's becoming a global issue, right? I mean, inflation is high all around the world, and therefore, policy responses around the world are going to change, and that's going to impact, liquidity and capital flows to countries like India as well. Now, in the case of India, there's no question that, inflation levels are elevated. Of course, they are, we do see this big divergence between input prices and output prices, because wholesale price inflation is very, very high, but core inflation and CPI is much lower. And frankly, I think that let me say two kind of analytical points on this. Yeah, one is that in places like the US, the worry is also that labor markets are so tight because quit rates have been very high, that the feedback from wages back to prices, and therefore the unanchoring of inflation expectations, is actually a real concern. In India, if the CMI data are right, labor markets are very soft. So in that sense, the unanchoring of expectations from labor market-based, pass-through mechanisms, wages, prices, I think are going to be less there. So finally, I think it's really going to depend a lot on how the RBI responds. And let me make a kind of a slightly controversial statement. I think in India, the social consequences of high inflation are quite adverse. I think both society and politicians are kind of sensitive to high inflation. And I've always felt that that makes the task of any of the central bank in India actually easier in some ways to address high inflation. So my sense is that based on all these things, both the central bank and the government and society at large, I think, have a preference for not having very high inflation. And I think that will get reflected in policy actions, both by the center and by the RBI. So I'm kind of cautiously optimistic that policy will respond effectively to over some medium term to make sure that inflation and inflation expectations don't get out of control.
So, Professor Arvind Subramanian, thank you very much for your excellent talk and also the great interaction, like the argumentative Indian, it's quite a good interaction. And then over to Rajeshwari.
Yes, thank you so much. On behalf of the MFC Organizing Committee, Dr. Subramanian, we want to extend a heartfelt gratitude for a really thought-provoking and insightful session. And as Professor Mahendra Dev said, you've given us, all of us, a lot of food for thought. I would like to just say that we would love to have you over on the campus. We'd love to host you here in person, as and when travels get safer and we are all in a situation where we can all meet in person instead of virtually. But thank you so much for taking all the time to answer the questions. I would just request all the participants to please switch on their videos so that we can take a quick snapshot to remember this nice moment. And I'll let you know when the picture is being taken. Thank you so much. Let me know when it's done. Done? Okay, so I'm told that it's done now. So thank you once again. And
thank you.
Thank you, Arvind.
Thank you.
Thanks so much. Thank you for having me. Thank you.
Thank you. We take a quick break now, and then we reconvene at 8 p.m. for the special session in honor of Dr. Subir Gokarn. Thank you so much. Thank you, Professor Mahendra.
Yeah, thank you. So we can stay back, no? Here we can keep.
Yes, we can stay muted with the videos.
Yeah.
Stay back. Yeah, exactly. Thank you.
Mahendra, hi. Good evening.
Good evening.
This is Nalan. How are you?
Hi. So you are in the US, or?
Yes. That's where I live. So I'm here at the moment.
Okay.
Good to see you. It's
Yeah.
I've caught only a few of the sessions, but looks like it's been a very successful.
Yeah, very good.
Yeah, and successful virtual conference.
Because this Omicron is there now, so we didn't want to take chances.
Yeah, it's just such a terrible situation, and it's just going on and on and on.
Yeah.
So, but you folks must be exhausted and also happy that it's the last session of the conference.
Yeah.
So
no, it will be a good one. Yeah.
Okay.
Yeah.
Mahendra, I'll mute myself and also stop the video.
Yeah.
And then join once the session starts. Okay.
Dr. Subramanian, good evening.
Good evening, Mahendra. Yes. I've muted myself, but yes.
Okay. So,
are we on track for everything?
Yeah.
Okay.
It was a very good conference.
Okay. Yeah, I can see that.
Yeah.
Yes.
Just now we had Arvind Subramanian's lecture.
Obviously, it must have been a sellout.
Yeah.
Yes.
Yeah.
Good evening. This is Rajendra Vaidya here from IJIDR.
Good evening, Professor Vaidya. Yes.
Hello, Mr. Nainan. Good evening. Hi, Josna.
Good evening, Mr. Nainan.
Oh, they can't. They have this thing muted.
Okay.
Yeah.
We have to add Nainan, right?
Yeah, I think because he's going to speak, no? So
yeah.
Lingaras, add the speakers. So we have 2 minutes.
Okay, now I think I'm audible.
Yeah.
Good evening, Dr. Subramanian. Good evening, everybody.
Good evening.
Dr. Subramanian, are you in Singapore or Delhi or no, you're muted?
Muted, yeah.
Yeah, good evening. Good seeing you. I keep reading you. I'm in Hyderabad.
You're in Hyderabad, okay.
Yeah.
Well, it's a very pleasant time in Hyderabad, weather-wise.
It is indeed. For the last 1 week, it's been very pleasant.
Yeah.
Yeah.
Okay.
Yeah.
You don't spend a lot of time in Singapore?
I finished with Singapore.
Oh, I see.
And then I was at Penn for some time. But since the lockdown, I've been in Hyderabad.
Okay. So we have 3 former Reserve Bank governors in Hyderabad. Dr. is in Chennai.
Dr. Rangarajan is in Chennai. Dr. Reddy is here. Unfortunately, Mr. Narasimham had passed away.
Yes.
Yeah.
But Dr. Rangarajan keeps going to Hyderabad.
Yeah. He lives, I think, yes.
He was governor over there. So
Yeah.
So we'll start. So
don't see her.
Yeah. So we'll start the session. Good evening. I would like to welcome all of you to this special session in honor of Dr. Subir Gokarn, former Executive Director, IMF for India, Bangladesh, Bhutan, and Sri Lanka, former Deputy Governor, the Reserve Bank of India, and former faculty IGADR. On this occasion, it's my pleasure to welcome the chief guest of this session, Dr. Duvuri Subbarao, former Governor of the Reserve Bank of India. And I would like also to welcome our speakers in this session, Mr. T.N. Nainan, former editor, Business Standard, Dr. Nalin Kishore, a natural resource economist and consultant, the World Bank, Mr. D.K. Joshi, Chief Economist, CRISIL, and my colleagues, Dr. Rajendra Vaidya, Dr. A. Ganesh Kumar, and Dr. Jayati Sarkar. During the special session, the top 3 papers of this 19th Macroeconomics and Finance Conference will be awarded the Dr. Subir Gokarn Best Paper Awards, as well as microsite dedicated to Dr. Gokarn's policy writings and work at IGADR will be launched. So it is for the very first time that Best Paper prizes are being instituted in our flagship conferences. And given Dr. Gokarn's close association with different activities of the Institute, including the macroeconomics and finance conferences in the past, throughout his distinguished career, we thought that this special session would be the best way to commemorate his contribution to economic policy and research. So I would like to thank the present governor, Dr. Shaktikant Das, chairman of IGADR Board of Management, for readily supporting this initiative. The Best Paper Awards are being sponsored by Dr. Josna R. Bapat, spouse of Dr. Subir Gokarn and the Gokarn family, and co-sponsored by TVS Capital Funds Limited. We thank Dr. Josna Bapat and the Gokarn family and Mr. Gopal Srinivasan, Chairman and Managing Director, TVS Capital Funds Limited, for their sponsorship of these awards. I would also like to thank Subir's close friends, Dr. Nalin Kishore, Dr. Nirmal Mohanty, Mr. Probir Roy, and Mr. Narendra Singh for their idea of creating a microsite as a tribute to Dr. Gokarn to provide widespread access to his policy writings for students of economics, especially those at the undergraduate level. The institution is happy. The institute is happy to host this microsite to facilitate this noble objective. This was coordinated at our end by colleagues, Dr. A. Ganesh Kumar, Dr. Subrata Sarkar, Dr. Jayati Sarkar, and Mr. Lingaraj Panda, our IT head, and his team. Moving on with the proceedings, may now invite Dr. Rajendra Vaidya, faculty IGADR, to give all of us a glimpse into the professional life and achievements of Dr. Subir Gokarn.
Thank you, Professor Dev. For those of you who did not have the fortune of getting to know Dr. Subir Gokarn personally, let me just in very brief go over his extremely successful career. Dr. Subir V. Gokarn, who was my friend and colleague at IGADR, was born in Mumbai on the 3rd of October 1959, the only child of Nirmala and Vittal Gokarn. After completing his undergraduate studies at St. Xavier's College, University of Bombay, and a master's degree at Delhi School of Economics, Subir moved on to do his PhD in economics at the Case Western Reserve University in Ohio. His doctoral dissertation was on the impact of capital market liberalization on industrial performance in South Korea. His professional career began at IGADR Mumbai in 1991. I was fortunate to get to know him as a dear friend and co-author, and we collaborated on quite a few projects together. During 1997 and 1997-98, he was a Fulbright Fellow at the Economic Growth Center at Yale University. And quite fortunately, at that very time, I was spending a year at Boston University on a Ford Foundation postdoctoral fellowship. I very fondly remember my very frequent trips to New Haven. We returned to IGADR, and 2 years later, he moved to New Delhi as Chief Economist and IFCI Chair in Industrial Development at the National Council of Applied Economic Research. Subir then moved to Standard & Poor's Asia Pacific and CRISIL in 2002 as chief economist, a position he held till 2009. Subir served as the Deputy Governor of the Reserve Bank of India between 2009 and 2012, where he oversaw monetary policy, research, financial markets, communications, and deposit insurance. During this time, he was also a member of the governing board of IJIDR. In 2012, he joined Brookings India in New Delhi as Director of Research. He was appointed Executive Director on the board of International Monetary Fund in 2015, representing India, Bangladesh, Sri Lanka, and Bhutan on IMF's executive board. He served in this position till his sudden and untimely demise in 2019. He was a prolific columnist for Business Standard in India and a frequent commentator on television. His ability to work effectively across academia, government, and business demonstrated his abiding interest in applying economics to the real world. His career research interests have primarily been in the reforms process and its interrelationship with economic performance. He has addressed these issues from a variety of perspectives, cross-country comparisons with particular focus on East Asia, and at macroeconomic and sector industry levels in the Indian context. His research has resulted in a number of publications, including 2 co-authored books on the performance of East Asian economies and a co-edited book on the structure of Indian industry. The issues he wrote on and researched remain both contentious and relevant even today. I must thank Mr. Janak Nabar, Subir's nephew, who helped in outlining his very brief bio. Thank you. Over to you, Professor Mahendra Dev.
Thank you, Rajendra, for providing a glimpse on Subir's professional life and achievements. As Rajendra mentioned, I would also like to thank Subir's nephew, Mr. Janak Nabar, for putting together a slideshow capturing memorable moments from Subir's life. Now, I would like to introduce Dr. Duvuri Subbarao, our chief guest for this special session. Dr. Subbarao served as Governor of the Reserve Bank of India for 5 years, 2008 to 13, during when he was also the chairman of IJDR's Board of Management. Prior to that, he was Finance Secretary to the Government of India and Secretary to the Prime Minister's Economic Advisory Council. Dr. Subbarao joined the Indian Administrative Service in 1972, topping the highly competitive civil services entry examination in that year. As a career civil servant, he worked in various positions in the state government of Andhra Pradesh and in the federal government of India. He was a lead economist in the World Bank during 1999 to 2004. Dr. Subbarao studied at the IIT in Institute of Technology, Kanpur, the Ohio State University, and at MIT. He was alternate governor for India on the governing boards of both the World Bank and the IMF. As Finance Secretary to Government of India and later as Governor of RBI, he participated in a G20 meeting and the meetings of the Bank for International Settlements. After stepping down as Governor RBI, Dr. Subbarao was a distinguished visiting fellow at the National University of Singapore and most recently at the University of Pennsylvania. So now I would like to invite Dr. Subbarao to speak on Subir's legacy in RBI. Over to you, Dr. Subbarao.
Thank you, Mahendra. Today's event to honor the memory of Subir Gokarn is very special for me. As most of you know, he was my colleague in the RBI, and we went through very turbulent times. The global financial crisis, the Eurozone sovereign debt crisis, rupee tantrums, an extraordinary bout of high and persistent inflation. And all this as the government of the day was getting weaker day by day politically. Through all these turbulent times, Subir gave me extraordinary moral and intellectual support. I've grown to respect him as an economist, value him as a colleague, and trust him as a friend. As Professor Vaidya just showed us, Subir's career straddled a wide variety of fields, institutions, and organizations. He was in the academia, in the IGIDR. He was in think tanks like NCAER and Brookings. He was in market institutions, S&P and CRISIL. He was a columnist for Business Standard. He was at apex policy-making level in the RBI, and he was in an international institution like the IMF. What's common across all these facets of Subir's career is that he excelled everywhere. He made a difference, and he influenced policy. It's unfortunate that it gone away even as the best was ahead of him. I remember the first time I met Subir on a rainy Saturday afternoon in July 2009. The position of Deputy Governor RBI had fallen vacant. Many prominent economists in the country had met me to express their interest in the job. Subir was not one of them. But Nayanan of Business Standard and Shankaracharya both told me that I must look at Subir. So I invited him to come and see me. That was that meeting we had on the Saturday afternoon. I remember very distinctly, it was a holiday, the office is closed, there were just two of us, and it was raining outside. The conversation rolled on for about 2 hours. We talked about the economic situation within the country and around the world. We talked about RBI, we talked about his career and my career, his family and my family. We talked about living in Delhi and living in Mumbai. We even talked about Bollywood. And even halfway through the interview, I realized he was my man for the position of Deputy Governor. I also remember the last time I met him, Urmila and I were visiting Washington. I think it was August 2017. And Josna and Subir were kind enough to invite us for dinner to their house. I was deeply touched that Subir personally cooked the meal for us. Maharashtrian vegetarian meal for me and Konkan seafood for Urmila. And he even presented to me a CD of the complete Big Bang Theory. We spoke a few times after that. The last time we spoke was about 4 months before he passed away. I was in Singapore at that time. Almost the first thing he told me was, Subha, you've fallen off the map. We don't hear or see you anymore. And I told him, Subir, I'm in the academia now. I'm not glued very deeply into Indian economic situation. I feel uncomfortable about weighing in on them. Subir said, Subha, you're being too diffident. I think you should engage on India's macroeconomic issues more frequently and more forcefully. I was deeply touched once again by his concern for me. As I think about Subir today, my thoughts naturally go back to the time we spent together in the RBI. As I said, there were very turbulent times. We had confronted many dilemmas, many challenges. But it also strikes me that many of the challenges and dilemmas we confronted at that time are similar to the dilemmas and challenges that the RBI is confronted today. Just to give one example, exit from the extraordinary easy policy. As I said at that time when I was in the RBI, exiting from easy policy after the crisis is like getting out of a Chakravyuh. Chakravyuh in Mahabharata, it's easy to get in, very difficult to get out. RBI today is in a similar situation. 10 years ago, we were in a similar situation. Look at RBI's dilemma today. They're caught in managing the tension between supporting recovery and containing inflation. Yes, we have a V-shaped recovery, probably clock growth of 9.5% this year. But even if we do that, output this year will barely equal output 2 years ago before the pandemic hit us. And that will still be below what the output would have been in the absence of the crisis. So there is, in some sense, a permanent loss of income. On the other hand, RBI also has to worry about inflation. Inflation has been above the midpoint of the target range. Core inflation is very strong. RBI is caught in navigating between supporting recovery and combating inflation. 10 years ago, we were in a similar situation. We recovered from the global financial crisis before advanced economies, in fact, even before many emerging markets, but inflation caught up with us. And we had to decide how and when to exit from the easy policy. Just as 2 months ago, as the second wave had abated, and we thought the situation was good for RBI to normalize policy, Omicron had hit us, a fresh bout of uncertainty. It's not clear how Omicron will affect inflation. It's not clear how Omicron will affect growth. There was a similar development at that time, 10 years ago. Just as we thought we were ready for normalizing policy, the Eurozone sovereign debt crisis hit us. So I can quite imagine Subir today engaging in the exit policy. Take another issue on top of RBI's agenda today about launching a digital rupee, a central bank digital currency. I can very well imagine Subir engaging in on the macroeconomic and monetary policy implications, the risks and the costs and benefits of a digital rupee. Subir made an enormous contribution to the Reserve Bank of India. He left a legacy behind. The only way to measure a person's legacy is to see how much lives on after that person has departed. By that test, Subir made enormous contribution. I want to use this occasion to recount some very significant policy and process and content improvements that Subir brought on into the RBI. The first thing Subir brought was a deep and refined sense of the market. The RBI has outstanding economists, impressive subject matter knowledge, very high professional integrity. Where Subir made a difference was to bring a market sense into that, to calibrating policy. Let me give an example. We know that when inflation goes up, demand for gold goes up. That is textbook economics. That is standard knowledge. But where Subir made a difference was to investigate and tell us which is a tipping point. How long does inflation have to persist at a high level when it triggers demand for gold? How long does inflation have to subside before demand for gold comes down? Those are the issues on which Subir made a difference. Again, another example. We know that inflation expectations matter. In fact, RBI does, I think, a quarterly survey of inflation expectations. But how are inflation expectations formed? How are they formed in urban areas? How are they formed in rural areas? This is where Subir added value. Subir also used the sense of the market to bring improvements in the content and process of monetary policy formulation. Let me give some examples. When Subir and I went into the RBI, the Reserve Bank was doing half-yearly policy reviews twice a year, with the result that there was a 6-month gap between one policy review and another. A month after coming into RBI, Subir came to me and said, Subha, this is untenable, that lots of things are happening. Rapid developments are happening in the economy in India and around the world. RBI switches off, RBI is silent for 6 months. The narrative is being shaped by market, by commentators, by analysts, by economists. We cannot let this happen. So we switched from a half-yearly review to a quarterly review, and that had enormous positive impact. Subir also streamlined policy statements. When he and I went to RBI, many of you might recall, RBI used to put out 2 solid documents before every policy. They were very substantive, very significant. very impressive, but nonetheless, very voluminous, with the result that the core messages were getting lost. Subir said we must shorten it. And we reduced the policy statement to 4 pages, which survives even today. And I recall very many meetings we used to have for the policy, the run-up to the policy in drafting. Subir would bring nuances into it and robust economic rationale. See that everything is consistent, that our walk is consistent with our talk. I can remember very well, one example. We had to say, like, with today's interest rate policy interest rate action, the interest rate is close to neutral rate. Now, should we say the interest rate, the policy interest rate is close to neutral rate, or should we say the policy interest rate is closer to the neutral rate? No, it's just one letter between close and closer, but that made enormous difference to what we were trying to communicate. I can remember we debated that for about 15, 20 minutes, and I'm still impressed with that insights that Subir brought. Subir also came and told me that we must have an analyst conference following every policy. And I said, why should we have an analyst conference? We're having a media conference after the policy we've disseminated, we're doing everything okay. Then he said, no, I think it's important to have an analyst conference calling. I was quite, was not sold on the idea, but I deferred to him. And I realized that it was a very, very value-adding thing. Again, I'll give you one example. In one statement, we said, given the current growth and inflation trends and today's rate action, the likelihood of further rate action by the Reserve Bank of India in the immediate future is quite low. Sure enough, there was a lot of commentary, a lot of analysis on what we meant by that immediate future. And the next day, I mean, people were speculating on that. The next day in the analyst conference, that question came up and gave us an opportunity to explain what we meant by immediate future. So these are some of the nuances, some of the finer things that Subir brought to bear on policy making. Third, Subir, like I was quite keen on opening up the RBI, opening up communication channels, demystifying RBI. And Subir reinforced that in many ways. Even before us, there was a tradition in the RBI of a drill of consulting all stakeholders, but we expanded and most streamlined it further. And Subir made a tremendous contribution to that. The fourth thing Subir did was put enormous emphasis on research within the RBI, which is very, 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 very important. He launched a project on structural drivers of inflation. He launched another project on the impact of the rainfall distribution on inflation, not just spatial distribution, but even temporal distribution. In fact, if Subir were around today, I can quite imagine him launching a project on the impact of Instagram on inflation expectations. The final thing that I want to cite by way of Subir's contribution to RBI is that he encouraged young researchers to read, write, and disseminate. And he designed a scheme of incentives for young economists in RBI to read and write economics. There's a lot that young economists can learn from Subir's life and work. In fact, a lot of people come and ask me, sir, how can we become a policy economist? I can understand that aspiration. I can understand that ambition. I can even understand that bewilderment. Not everybody can become an economist in the RBI or the government. Indeed, not everybody might want to become an economist in the government or the RBI. There are very many ways of influencing policy, as Subir's life and work show. So since a lot of young economists are in this audience, I want to cite 5 things that people can learn from Subir's life and career, young economists. The first thing they can learn is to apply economics to real world problems. Of course, to be a policy economist, to be an influential policy economist, you have to be a good economist. You have to know your macro, your micro, your developed economics. But you also have to know that economics is not an exact science. That in applying economics, you have to remember that there are no immutable laws in economics. Just to give an example from physics, which I'm familiar with, laws of physics are immutable. The second law of thermodynamics, for example, which says that heat lost is equal to heat gained, is true across space and time, across the entire universe for all time. But laws of economics, that supply is equal to demand or saving is equal to investment, they're not immutable. So young economists have to know how to apply economics to real world problems. Subir excelled in that. The second thing young economists can learn from Subir's life is understanding real world development, something Professor Vaidya referred to. To give an example, food inflation. Food inflation is up today. Food inflation was up during our time. And every month when the inflation number comes up, analysts and economists say inflation, food inflation has gone up, because price of oil has gone up, price of diesel has come down, whatever, all that analysis. But drill down further. Why has food inflation gone up? And Subir used to apply his mind to those issues. In fact, Subir's legacy will live for a long, long time, indeed forever, for understanding the dynamics of food inflation. He was the first economist within the RBI or outside to talk about protein inflation, to understand that the food inflation that we were having is because of protein inflation. And that itself is an outcome of people's incomes going up. As incomes go up, people shift their dietary habits from protein to, from cereals to protein. Subir was the first economist to say that. In fact, I mentioned to Dr. Manmohan Singh, who always used to be troubled by the economic situation. I once told him, sir, inflation that we're having today is a problem of success in some sense, that incomes have gone up. In fact, I would encourage young economists today to read Subir's speech on the price of protein. I think he gave that speech in IGIDR actually, sometime in October 2011 or some, I don't remember, but it's on the RBI website. The third thing young economists can learn from Subir is to keep their eyes and ears open. You know, you learn things at unanticipated moments from unanticipated people, from stray comments, from a conversation that you're not actually focused on learning, but you learn. Pick up a lot of things. Subir was very good at this. I mentioned this before. He once called a meeting of RBI chair professors. We have, I think, about 10 of them across the country. And he came and told me, Subha, I think you should come and chair that meeting. So I tried to beg off, saying that, look, I'm busy and I've got other things. And, you know, next time I'll come, can you handle this? I could see from the glint in his eye, his disapproval of that. So I went for the meeting anyway, and it was such a rewarding learning experience. So Subir was very good at that, in learning, in keeping his mind open. The fourth thing Subir was good, and this is very clear, was at communicating economics at all levels, at professional level, at journalistic level. I once heard him talk about inflation to class 10 students in a high school. So the test that young economists should ask themselves is, can I explain this to my mother? And Subir was very good at that. The final thing Subir, young economists can learn from Subir is to be a good economist, you have to be a Renaissance man. It's important to specialize, it's important to super specialize, but it's also important to have a breadth of knowledge beyond economics. And Subir had enormous breadth of knowledge beyond economics. People tend to develop tunnel visions, and I think that's something to be shunned. I need hardly tell you that some 10 years ago, the Nobel Prize in Economics went to a psychologist, Daniel Kahneman. So it's very important for economists to keep their eyes and ears open to have a breadth of knowledge. So to conclude, Subir's legacy in the RBI lives on. He made enormous contribution, not only to the RBI, but to macroeconomic management in the country. Young people aspiring to be policy economists can learn a lot from Subir's life and work. I'll always remember him as a sharp macroeconomist and as a warm human being. To Josna, I must say you must be proud of your husband. To Kanak, I want to say you must be proud of your father. And I want to compliment IGIDR for organizing this event to celebrate Subir's enormous contribution. Thank you.
Thank you, Dr. Subbarao, for your insights on Subir's legacy in RBI. As you know, Subir was a regular columnist in the Business Standard, which was being edited by Mr. T.N. Nayan at that time. Mr. Nayan, through his good offices with the Business Standard, has facilitated the development of the IGIDR microsite, where a selection of Subir's media writings are being hosted. Now I invite Mr. Nayan to speak on Subir as a columnist.
Thank you, Dr. Mahendra Dev. I hope I'm audible.
Yeah, you are audible.
Thank you for the opportunity to be a part of this event commemorating Subir's life and writings and contributions to economics and economic policy. I will speak briefly on Subir's engagement with the Business Standard. I first met him at, I think, the first Nimrana conference, which the NCAR had jointly organized. And shortly after that, we get the paper, TCA Srinivasa Raghavan suggested giving him a fortnightly column because TCA was running the edit page at that time. And he said, why don't we give Subir Gokarn a fortnightly column? And I thought it was a good idea. And then he was invited to start writing his column. One of my convictions at the paper as a journalist was that journalists don't know enough. We preach to the world, we tell the government and the Reserve Bank and others what to do and what not to do. And unlike a general newspaper, in a business newspaper, our readers are often, if not usually, better informed than we are. So I felt the need very strongly to bring in real knowledge at a different level into the paper's deliberations before we actually commented on issues. And so we had a Monday morning's Brains Trust where people who were economists, foreign policy experts, and others would come in and spend a couple of hours just shooting the breeze, sometimes just gossiping about politics or discussing cricket. And we invited Subir to be a part of that Monday morning Brains Trust at the Business Standard office. And Subir used to come straight from the Habitat Center where he had gone to the gym or had a swim. And so he would walk in with the large box of cookies that he'd brought at the Habitat Center. And there were lots of biscuit champions in the office, so those cookies disappeared very quickly. So he was always doubly welcome because of that. And then he had another role in the paper, which was a third role, which was to write the editorials. There was a long phase when he was actually the secret author of most of our editorials on economic policy. And he didn't particularly care what he was saying, because he said, I'm a keyboard on hire for this. So whatever the group had discussed and thought we should say, he would just bang it out in, very quickly, in half an hour or 45 minutes. And it was clean prose. It was simply written the way it should be in a newspaper, and it had a clear set of ideas that he put forward. So he was of great value for his contributions at the Monday meetings, which were very sensible. He had a dry wit, and his editorials and his column itself. So at an earlier meeting, shortly after he passed away, I had read out to the group at that time, and this was at the NCAR in Delhi, a really witty column which on dogs, which he'd written once. Today, I want to focus on a somewhat more substantial issue. He wrote a column once, basically saying, "You can't kill two birds, ... And I refer to this because of our immediate events to do with economic reform. And Subir's column basically focused on the idea which was put forward by Jan Tinbergen, that you can't take one policy instrument and serve multiple objectives with that. For each objective, you need a policy instrument. And the point that Subir made was that if you want to use the procurement mechanism and the support price mechanism to do something in agriculture, you are giving a double guarantee if you both guarantee offtake as well as guarantee the price. And you can't do that. For each policy objective, you need a separate purpose. And when you look at what has happened to the agricultural reform, marketing reform laws that have now been repealed, this is very relevant, because on the one hand, you want to offer an income support, and on the other, you want to have some offtake to feed the public distribution system. So you need two instruments for that. One is income support and one is procurement. And you can't have unlimited procurement as well as a guaranteed price. And this applies equally well to the labor reform program, that when you do labor reform, you want a flexible labor market, but you also want some kind of safety net. And you can't do both with the same reform by saying we're opening up the market. You need some kind of safety net, which is separate reform from offering a flexible labor market. So it was this kind of insight that he brought to his columns, which were particularly useful right through the period that he wrote for us. Of course, we became a friend. In his last visit to our office on a Monday morning, he happened to be in Delhi. He'd come from Washington and the IMF for some discussions, and he lost a lot of weight. He was clearly unwell, but he was, dismissed all concern by simply saying, "I've got over it. I'm well and fine, and don't worry," and went off. And then, of course, shortly afterwards, he was no more. So I always remember him very warmly. For all the things that he was and from the many things that he did. And I want to thank and compliment IGIDR for the initiative with the support of the Reserve Bank and TVS and others, and Jyotsna's constant efforts to do this prize initiative in Subir's honor. Thank you very much.
Thank you, Mr. Nainan, for your remarks on Subir as a columnist. Now, I invite Dr. Subbarao to launch the IGIDR microsite on Dr. Subir Gokarn. Thank you, Dr. Subrao, for inaugurating the IGIDR microsite. I now request my colleague, Dr. Ganesh Kumar, to give a tour of the microsite.
Good evening. It's my pleasure to give a virtual tour of the microsite that we have developed at IGIDR in honor of Dr. Subir V. Gokarn. I have here in front of me I've already opened the homepage of IGIDR, www.igidr.ac.in. All you need to do is you have to scroll down this homepage, and here you will see a button which shows Subir Gokarn tribute. So when you click on this button, it takes you to the microsite which has been developed in honor of Dr. Gokarn. The microsite gives you a brief account of Dr. Gokarn's bio, and it highlights some of the a selected set of media writings published by Dr. Gokarn in the Business Standard, his academic publications when he was a faculty at IGIDR, and the PhD students whom he supervised while he was at IGIDR. Turning first to the selected media writings, we have provided a brief introduction to the media writings. It gives a background to the very idea of the microsite that we have developed here, and also mentions the team that has worked in developing the microsite. The writings in media have been categorized in different headings, such as business economics, central bank policies, and so on. If you click on any one of them, it will list the various articles that he has published in the Business Standard, and also gives the date of publication of the article. So when you click on any one of them, you will see an abstract of the article and also the link to the original article in the Business Standard itself. So one can access this way, one can access various articles that Dr. Gokarn has published in the Business Standard. So one can choose any topic that one wants and go through and find what is of interest to one person. Turning to the academic publications, Dr. Gokarn has published some books while he was at IGIDR. These are some of his, these are the research papers that he has published in academic journals, the discussion papers, and the project reports that he brought out while he was at IGIDR. And as I mentioned, here we have listed the names of his students, their PhD thesis titles, and also the year that they got their PhD degree while they were at IGIDR. So I hope you enjoy the microsite, which we are dedicating in honor of Dr. Subir Gokarn. Thank you.
Thank you, Ganesh, for the virtual tour of the microsite. I hope the microsite would serve its objectives. I now invite Dr. Nalin Kishore, natural resource economist and consultant, the World Bank, to speak on Dr. Subir Gokarn's policy writings and their significance. He has been one of the initiators and has been part of the team that developed the microsite. Over to Dr. Nalin Kishore.
Thank you, Professor Mahendra Dev. I hope everyone can hear.
Yes.
Okay. Thank you again, and a very warm namaste to all those who joined this special session to honor the memory of Dr. Subir Gokarn. And it is very much my privilege and pleasure to share with you a few details on this initiative that we worked on as a tribute to Subir. I know many thanks have already been given, but I did want to recognize and acknowledge two of my closest partners in crime for this initiative, Narendra Singh and Nirmal Mohanty. We worked very closely together on this. And my remarks today will reflect really the collective thoughts of this group. So it's difficult to say anything more about the the intellectual might that Subir had and carried to discussions. As has been said again by the previous speakers, he was a very prolific writer. And I'm going to focus a little bit on that prolific writer aspect of Subir. And in that context, even more specifically on the writings that he made to the op-eds that he prepared for Business Standard, very prominent newspaper in India and influential as well, where his op-eds reached out beyond academics and the policymakers to a very wide audience. Between 1997 and 2017, Subir penned about 300 op-eds. And each op-ed reflects his depth of knowledge about the Indian economy. Each is an illustration of how formal economic principles can be used to understand a wide variety of development challenges. And each is written with such compelling clarity and brevity that the Aam Aadmi can easily appreciate the analysis and the proposed solutions that were given there. So given the unique qualities of Subir's op-eds, combined with their analytical rigor and deep economic insights, it became obvious to us as readers that they are not just of historical relevance, but can contribute to a better understanding of today's development challenges. And additionally, again, this has been articulated by Mr. Nenan, for example, that they're models of how to communicate complex ideas in a language which is easily understood by the layperson and the daily reader, the casual reader. So this thinking led very naturally to the idea of making these op-eds accessible to a wider audience in a one-stop shop. And we ended up spending the last about 1 year working together to bring this idea to fruition. And a huge thanks to IGIDR who for their unwavering support for this initiative. So Dr. Ganesh Kumar has already given you a sort of a flavor of the select media writings tab that he showed a minute ago. I'll go a little bit more into it in the next minute. So on the website, you will now find an initial collection of 96 op-eds. And again, as Dr. Kumar illustrated, we've prepared a short abstract for each op-ed that captures the main ideas of that piece. They've been organized into 13 categories, ranging from central banking policies to international economics, to macroeconomics and business cycles, to public finance and so forth, to facilitate search and research. And going forward, we hope to continue adding more such summaries of Dr. Gokarn's op-eds. So I would invite you to browse these op-eds, and I'm convinced that you'll find them useful as well as really a pleasure to read. Certainly Narendra and Nirmal and I had many an engaged discussion stemming from them when we were reading them. And one of my favorite pieces actually happens to be You Can't Kill Two Birds, that Mr. Nenan just talked about at length. And as economists, we often forget that you need to have at least one instrument for each target that you want to successfully address. And if we don't have at least that many at the minimum, I think we can often land up in trouble. Anyway, so please do take a look at those pieces, and hopefully you'll find them as compelling and as relevant as we do. And just in conclusion, I would like to say that this initiative is a fitting, albeit a modest tribute to the intellectual contributions of Dr. Gokarn, We also think that it will particularly benefit those engaged in critical thinking, research, and policy writing in the Indian economy. And importantly, we see this to be a terrific resource for university students and teachers alike. So thank you very much. And back to you, Dr. Mahendra Dev.
Yeah, thank you, Dr. Nalin Kishore, for your speech on Subir's media writings. Subir, in his distinguished career, has taken up multiple roles as an economist. Mr. D.K. Joshi, the chief economist of CRISIL, was Subir's colleague and is one of the original ideators of the Best Paper Awards. I now invite Mr. D.K. Joshi to speak on his reflections on Subir at work as an economist.
I had the good fortune of knowing late Dr. Subir Gokarn for over 2 decades. I would like to talk about 3 very distinct qualities of Subir that have stayed with me all through. These, I believe, make him stand apart as well. First, Subir's intellectual prowess, his ability to connect dots and communicate with clarity is very well known. But if you talk to people who worked with him, they will tell you that this is not the primary reason why they will always remember him and always respect him. His human qualities of large-heartedness and fairness, and also his wisdom and his wit, stays with almost everyone who worked with him. The way he treated his co-workers with utmost respect showed his empathy and his sensitivity. Second, he had a hands-off approach to managing and mentoring his team. He provided guidance and direction, but also gave his team members enough space so that they could develop and tweak their own frameworks. Also, it did not matter where you worked from home or office. As long as you did your job, it was fine. This provided a lot of flexibility to his team members and was very well appreciated. Original work from home, if I may say. Third, he set up the CRISIL Center for Economic Research in 2002. He gave it the intellectual heft to make it a credible, balanced, and respected voice on economic as well as policy issues. He was a very keen observer, and the new ideas for research would often stem from what he observed around him. It could be the state of infrastructure that he observed while going to office every day, or it could be stubble burning or the monsoon rains. One example of this is creation of an index which summarized the impact of deficient monsoons on the agriculture. This was in 2002, which was a very bad monsoon year. He felt the need to add value to the weekly rainfall data which the Met provided. We ended up creating a simple index called DRIP, Deficient Rainfall Impact Parameter, and we still use it every monsoon season to track the impact of deficient rains on different crops and across different states. He gave us so much to remember. Thank you very much.
Thank you, Mr. Joshi, for highlighting Subir as an economist. We now come to the much awaited, the Best Paper Awards function. As mentioned earlier, the conference this year introduces the Dr. Subir Gokarn Best Paper Awards in memory of Dr. Gokarn, which will award cash prizes of rupees 1 lakh and a citation, rupees 50,000 and a citation, and rupees 25,000 and a citation to the 3 best winners. Our chief guest, Dr. Subbarao, has graciously agreed to present the awards, which has been chosen by an external jury. We received 152 national and international submissions this year, all of which were subjected to a double-blind peer review process, with 15 papers selected for presentation over the 3 days of the conference. A special awards committee comprising of Dr. Chetan Ghate and Dr. Sushant Malik was set up to choose the best paper awards. Yeah, from the 15 final presentations. From IGIDR, my colleague, Dr. Tanya Ghosh, facilitated the award committee. I will now introduce the awards committee members. Dr. Chetan Ghate is a professor in the Economics and Planning Unit, Indian Statistical Institute, Delhi. His primary research interests are macroeconomics, monetary economics, and growth and development. He holds a PhD in economics from Claremont Graduate University in California. He was awarded the Indian Econometric Society 2014 Mahalanobis Memorial Gold Medal in Economics. He served on the Reserve Bank of India's TACT, Technical Advisory Committee for Monetary Policy, as well as the RBI's Monetary Policy Committee. Dr. Sushant Malik is a professor of international finance at the School of Business and Management, Queen Mary University of London. In addition, he has been the co-editor-in-chief of Economic Modeling, a leading journal in economics. He has a PhD in economics from the University of Warwick in the United Kingdom. He has nearly 100 peer-reviewed articles in reputed journals. So the award committee based their decision on 5 criteria. One is motivation. Second is execution. Third, novelty of results with policy relevance. Fourth, quality of writing. And fifth, presentation. So each of these criteria was given equal weight. I want to extend my heartfelt thanks to Dr. Ghate and Dr. Malik for giving their valuable time and being part of the Dr. Subir Gokarn Awards decision-making process. We now come to the announcement of the awards. I request Dr. Subbarao to announce the awards.
Thank you, Professor Mahendra Dev. I'm delighted to do this. The third Best Paper Award goes to Robert Bayer, Tarun Jain, and Sonalika Sinha for the paper Lights Out, COVID Containment Policies and Economic Activity. We congratulate them. Shall we move on?
Yeah.
The second Best Paper Award goes to Arpit Kumar and Parija, Arpit Kumar Parija and Vipul Mathur for their paper Banking Sector Expectations and Financial Stability. And here finally, the first best paper award goes to Oscar Joda, Sanjay Singh, and Alan Taylor for their paper, The Long-Run Effects of Monetary Policy. Thank you. Congratulations to all the winners.
Yeah. Thank you, Dr. Subbarao, for the virtual presentation of Best Paper Awards. So heartiest congratulations to the awardees and wishing you all the very best in your journey ahead. We now come to the end of the special session, and with it, the conclusion of the 19th Macroeconomics and Finance Conference. I now call my colleague, Dr. Jayati Sarkar, to give the vote of thanks.
Good evening, everyone. Before I give the vote of thanks, I would request all of you to switch on your videos so that we can take some pictures, albeit virtual, but still it would be nice. I'll just tell you when the photo session is over, and then I will start my vote of thanks. Big smile, everyone. they are now adept at these, picture snaps, snapping these pictures. Okay, thank you very much. The photo session is over, and now I can move on to my vote of thanks. Thank you, Professor Dev. And this is my absolute privilege and honor to present the vote of thanks on behalf of the organizing committee of the 19th Macroeconomics and Finance Conference that was virtually held over the last 3 days. This year's conference was in large part very unlike any of the 18 conferences that IGITR had organized since 1998. This is mainly because of its virtual avatar on account of the ongoing COVID pandemic. The organizing committee had no templates to follow, but at the same time, we wanted the conference to continue to serve its objectives, albeit through a virtual platform, of bringing together scholars from all over the world who are engaged in quality research in macroeconomics and finance, particularly with respect to emerging economies like India. I think and I hope that we have largely met these objectives. Excuse me. We are grateful to an entire spectrum of individuals associated with this conference in different capacities, and we would like to sincerely thank all of them. We're extremely honored that keynote sessions of our conference were graced by academicians and policymakers of great repute, Professor Frederick Mishkin of the Columbia Business School, Professor Hugo Panizza of the Graduate Institute of International and Development Studies, and Professor Arvind Subramanian of Brown University. We thank each of them for sparing their valuable time to share with the participants their insights based on cutting-edge research in macroeconomics and finance, particularly in the areas of monetary policy, financial crisis, sovereign debt, and of course, measurement of performance of the Indian economy. The conference this year was even more special because of the closing session on Dr. Subir Gokarn, our beloved former colleague, former Deputy Governor of RBI, and before his sad and untimely demise, Executive Director IMF for India, Bangladesh, Bhutan, and Sri Lanka. We are honored and thankful to Dr. Duvuri Subbarao, former Governor of the Reserve Bank of India, for acting as the chief guest of this session, for sharing his thoughts about Dr. Gokarn, for launching a microsite on his policy writings and academic work at IGITR, and also for presenting the Best Paper Awards for the top 3 papers presented at this conference. I'm sure the awardees were overwhelmed being receiving the awards from someone as illustrious as Dr. Subbarao. We would like to extend our heartfelt thanks to Dr. Josna Bapat, spouse of Dr. Subir Gokarn, and the Gokarn family for sponsoring the Best Paper Awards in Dr. Gokarn's honor. Dr. Bapat has been a guiding force behind the institution of the awards, and it is a great honor for IGITR that the awards were presented as part of the Macroeconomics and Finance Conference. Our sincere gratitude also to Mr. Gopal Srinivasan, Chairman and Managing Director of TVS Capital Funds Limited, for co-sponsoring the Best Paper. The prestige that is associated with the Dr. Subir Gokarn Best Paper Awards is reflected in the constitution of the awards committee, consisting of distinguished academicians in the areas of macroeconomics and finance, namely Professor Chetan Ghate of Indian Statistical Institute, Delhi, and Professor Sushanta Malik of Queen Mary University of London. Both of them are stalwarts in their respective fields, and we are deeply honored that they had accepted our invitation to be members of the awards committee. We are deeply thankful to Professor Ghate and Professor Malik for being an integral part of the awards adjudication process. They have spared their valuable time to sit through all the presentations and to evaluate the selected papers in various aspects. The launch of the IGITR microsite dedicated to Dr. Gokarn's policy writings and work at IGITR has been possible through the cooperative efforts of his friends and family and our team at IGITR. The journey has been long but extremely exciting, and I hope our joint vision is reflected in the microsite. Our sincere thanks to Dr. Nalin Kishore, Dr. Nirmal Mohanty, Mr. Prabir Roy, Mr. Narendra Singh, and Dr. Josna Bapat, as well as my colleagues at IGITR for their valuable contributions to this project. The quality of any conference hinges on the quality of the papers presented in the different sessions. I'm sure all of us will agree that each of the sessions is exciting and enriching in terms of the subjects covered and discussions that followed. We are extremely thankful to each presenter to be a valuable part of this conference. present their research with passion, take questions from the audience, and being totally immersed in the conference proceedings. Any conference session also critically hinges on the chairperson of the session. We were fortunate to have excellent chairpersons who enriched each session with their comments and observations, as well as conducted the session in a timely manner. We extend our sincere thanks to our esteemed chairpersons. The proceedings of each of our conference sessions, keynote speeches, and paper presentations were enriched by participation from the audience. We were overwhelmed with the wholehearted participation of a large number of audience members, and the time of the day really did not matter. One of our objectives was to give an experience as close as possible to in-person conference to all the attendees. Of course, we do recognize that is a tall order, but I hope that we have been able to create an interactive conference environment in a virtual space. It is now my pleasure and honor to thank, on behalf of the organizing committee, the individual at the helm of the 19th Macroeconomics and Finance Conference 2021, Professor S. Mahendra Dev, our esteemed Director and Vice Chancellor. We cannot thank him enough for inspiring us in organizing a high-quality conference and for encouraging us to reach out to researchers in macroeconomics and finance far and wide. Any virtual conference in the scale at which this conference has been organized is totally dependent on information technology. That this conference could be smoothly and successfully conducted without any technical glitches whatsoever, fingers crossed as I present my vote of thanks, is completely due to the diligent and round-the-clock planning, execution, and monitoring by our in-house IT team headed by Mr. Lingaraj Panda and his team. A very big thank you to you, Lingaraj, who's here, for being such a constant support. I would also like to take this opportunity to thank our enthusiastic and technically savvy student volunteers, Tanu Gupta, Abhishek Dureja, and Hardeep Singh, who took time from their PhD submission work to help us round the clock. I also take this opportunity to thank another very important individual, Mr. Jai Mohan Pandit, our registrar and his team, particularly Mr. Samir Parab, our administrative officer, our chief librarian, Mr. Shama Prasad Pujar, and also the accounts department, who have been of immense help at all administrative levels during this conference organization. I also want to thank the people who always remain behind the scenes, but without whose contribution this conference would not have been possible. And by that, I mean our excellent ground support team. The MFC organizing committee would not have been able to pull off this feat without the relentless help and effort of our conference secretariat, consisting of Ms. Martha Lobo, and also our communications officer, Ms. Sneha Singh, and administrative staff member, Tanmay Joshi. Last but not the least, how can I not thank my dear and esteemed colleagues in the MFC organization committee? Tanya Ghosh, Sargam Gupta, Rajendra Vaidya, and Rajeshwari Sengupta for their tremendous energy and effort and constantly helping me with their ideas and visions about making this a great conference. A special shout out to Professor Ganesh Kumar and Jayati Sarkar as well for their valuable contribution in creating the microsite of Dr. Subir Gokarn. I want to end this vote of thanks by extending my heartfelt gratitude to all my fellow colleagues of IGIDR who have enriched our organization process with their valuable inputs. Thank you once again for being such a wonderful audience for this MFC, and we look forward to seeing you again in the December of 2023, hopefully in person. Good night. Thank you.
Thank you.
Thank you very much.
Yeah, thank you. So we'll close the session and the conference.
Yes.
Yeah. Thank you for all of you for participating in this special session on in honor of Dr. Subir Gokarn.
Thank you.
Thank you.
Thank you all.
Thank you all.
So all our OC members, thank you on behalf of the OSM.
So we'll close.
Okay.